Right.
Good job, Peter. Gary.
Ready to rock and
Good
roll.
morning.
We're live? Test, test. Everyone hear me all right?
Yep.
All right. Morning, everybody. So I think if everyone's good, we'll get going here. So everyone's here today to go over the FY 2027 budget. So as you know, the last 4 or 5 years anyways, we've tried to come together on the first Saturday of December and provide both the select board and finance committee an overview of the budget. And behind you, as you know, also traditional in past years, are all the department heads here to answer any questions that pertain directly to operation or financial needs. I want to change this.
You guys can't escape, so. Really? Look, I get cramped in there. Jeff's cornered.
All right, so first, this is something, yeah,
You want us to open up our committees?
you what?
Do you want us
Oh, yeah, good point, Finn. No, actually, let's not bother.
You want to start? Finn, go ahead. Okay. So I will open up the meeting of the Wenham Select Board of December 6th at 8:40 a.m. Present for the Select Board are Deirdre Parati, Gary Cheeseman, Peter Clay, and Ben Timon.
Second.
Gary will vote.
Yes.
Peter?
Yep.
Deirdre?
Yes.
And Ben is yes.
Cheers.
This is Finn Sprague, Chair of the Wenham Finance Advisory Committee, opening the meeting here, as you said, at looks like 8:40. President, I've got 4 out of the 4 members of the committee. I don't know that we need to vote, but there you go. We're open.
Great, thank you. All right, so the first slide before we get into the finances is something that, I think every municipality, at least in the Commonwealth, struggles to do, or struggles to do well, and I'm not sure what the solution is, but to illustrate, kind of what we do and what, where the money goes. And part of that difficulty is that, or the town of Wenham and any municipality for that matter is a community, and not every service touches every resident equally. So, there's a lot of services on this list that you may have never, touched since you've, moved to town. But to know that, you're part of a community and that every one of these services does directly touch your fellow residents. And education is, probably the biggest example of that. A lot of folks maybe at one time had children in the school district and no longer do, or have moved to Wenham, after their kids have grown up or didn't have any kids, or, whatever circumstances they're in, education probably represents 50+%, maybe even approaching 60% now. We'll probably find that out in a little bit. But, and then so you're paying half of your tax bill goes to educating the kids of the community, and it's a service that, your family might not be directly receiving. And that same theme holds true for all of the other things. So, we've, in past years, and it's been streamlined, and we're kind of moving that information more into documents that are being published through town, being both the Wenham Wire, which is a newsletter. We're working on GFOA styled budget, which will incorporate more metrics into it. We're also including some of the metrics now into our annual town report. So, that's a way to try to get the message out to the community, like what actually each one of these departments does, and, kind of try to tie some numbers to it as far as, even though you've never called 911, but there's thousands of 911 responses in Wenham every year. So, and those, just trying to illustrate that. So that's really all on that. So with that, I don't know if anyone has any comments or anything before we jump into the more of the finance-specific information. All right, let's go. First, I just want to provide a quick overview for the folks that are not aware of, or looking in this room, I think most folks understand that on the revenue side of the equation, we're largely made up of our tax levy. So that's money that's raised through your property tax bill that you receive as a resident every quarter, where 86% of our revenue is supported by your tax bill. And then beyond that, we really have two other prime components. You have state aid, which is in this specific example stated as unrestricted government aid that comes out of the state. So that's aid that comes directly to the municipality. We have another piece of aid that goes Chapter 70 funding that goes, because we're a regional district, that goes directly to the Hamilton-Wenham Regional District, and is restricted only for educational purposes. And that holds true across all communities, but in some communities that don't have a regional district, you'd see that revenue source reflected in its entirety here. But for this case, we're at 2%. You can see the state, although they have slightly increased state aid over the last 10 years, it actually falls as a percentage of budget, because the budget, even though restricted at 2.5% plus new growth, so 3.5% growth, the state aid, their increases have not kept up with that increase, therefore reducing it as a percentage of total budget. And you're looking at local receipts would be things like excise tax, if you take a building permit out, conservation, planning, all those permitting fees that go into, that you pay to have the permit done is all part of that local receipts. What's that? Licenses. Yeah, licenses. So really, any fees, you pay parking passes for Pleasant Pond, things like that. So right down to, any money outside of taxes that you're paying to the town is captured in that local receipts bar. And you can see here on the right, the chart that shows that we are, not alone in our peer communities here up on the North Shore, and really anywhere in the Commonwealth. You would see a chart that reflected us similarly in that mid 80%. Something to keep in mind is that if you were to expand that view out and look at the larger communities, and certainly the gateway type communities, the larger cities, it's actually closer to the inverse of this picture here, where state aid would reflect probably 50 to 70% of their budgets, with their taxation coming in as more of a secondary component. So, our annual collection rate, really by any metric, is very good. So this helps the community for a couple different reasons. One, creditors see communities as in the Commonwealth of Massachusetts as most of them, particularly the smaller communities with high reliance on a tax levy like we are here, as a very safe investment. So generally you'll see that we have a lot of AAA rated communities in Massachusetts for a lot of the reasons is that, the money is, I don't want to, all but guaranteed, because the collection rates tend to be very high. Municipalities have, very little these types of municipalities have very little reliance on revenue sources outside of the tax levy. So meaning that local receipts and free cash, local receipts and state aid, which are much more turbulent in the times of economic downturns. We have little reliance on those, given our budget is primarily the tax levy. So, and then this just further compounds that, showing that we have a very reliable revenue source and a very high collection rate. And so free cash, I think everyone has a pretty good understanding of this, but for the folks at home that are watching, is, it's really, I think, when you talk to like the S&P, they'll always jokingly say on the call, we have Massachusetts and then you have everybody else. So Massachusetts requires us to account for our use an accounting method that's slightly different from the rest of the country. And so we're kind of forced to do both. And, our audit is one accounting practice, and then our DOR, the Department of Revenue submissions, are another accounting practice. So when they look at us, they look at undesignated fund balance, which is probably a more familiar term to folks here and at home that, work in the finance world. But it's essentially undesignated fund balance is primarily made up, when we're looking here tonight, of two components: the free cash and your undesignated stabilization fund. So free cash here is, we have a draft policy that hopefully will be finalized this year, but currently states 4 to 6%. This is a pretty widely adopted spread across most communities in the Commonwealth, and is a recommendation by the Department of Revenue, and is also a really derived from the undesignated fund balance recommendations that come from the GFOA, which is like the institutional municipal finance, International Municipal Finance Association, and their best practices. So, you can see that it kind of ebbs and flows in the years. We did recently go through a few years where we've spiked up over that draft policy. The policy was, has just started being circulated in the last few years. So there really wasn't a policy prior to that. But, we've taken direct action to try to bring it down into the 6%, 4 to 6% range. What you don't want to do, and what a trap that a lot of communities and even the school district did not saying that in a negative way, but you can see when you fall into the trap of you'll see some communities they'll have a high level of free cash, and they will start offsetting the reoccurring expenditures with free cash injections into the budget each year. And then when those one-time funds of free cash start to dry up or fall down into their stated range, you realize that, that hole has to be filled with something, and now you don't have the reoccurring revenue. So what we've done is we have kind of hit it by three-prong approach. We've ratcheted, tightened up on expenditures over the last 3 years or so. We've kind of reworked our revenue assumptions, so that now you're kind of raising your revenue assumptions a little bit, you're reducing your expenditures a little bit, and then we're also taking chunks. We instituted, I think 3 years ago as well, or 2 years ago, a standing budget item that funds a stabilization, and then we've also been making additional contributions into our stabilization fund. So we're kind of bringing it down that way. We're continuing with that methodology, as you'll see later, with this budget, and anticipating bringing it right down into the sweet spot between 4 and 6% next year. So here's the other part of that equation, the undesignated fund balance I stated earlier, is a stabilization fund and reserves. So again, component, is basically undesignated fund balance that is out of the GFOA is, anywhere from, 14 to 25% of your annual expenditures, which, you have to take every community has different approach when looking at their recommendations, because their recommendations apply to the entire country as best practices. But, we're a community in Massachusetts particularly that has a high reliance on a very stable revenue source of of your tax levy. When you leave Massachusetts, you'll see the community, the municipalities work more closely with their county government, and they also run more enterprise type operations. So usually you'll see the governments will be larger, but they're running, it kind of more like a business in some extent. So when you're doing that, the reserves become working towards the higher end of that recommended range becomes, probably more important, because your revenue sources are going to have large swings depending on what's going on in the economy at any given time. So you can see we've worked very hard and quickly over the last few years, because our stabilization fund, if you looked at a similar cohort to communities as the slide a couple slides before, when we were looking at revenue sources, we were, most of them are in this 5 to 10% range, and we were down in the 2 to 3% range for a while. So we identified that as our stabilization fund was low, so we've worked to bring that up, and actually are intentionally exceeding this was intentional to exceed our draft policy statement of targeting 5 to 7% in anticipation of the new trash contract that will have to be acted on this year. It'll have to be effective July 1, and we're anticipating, back a number of years ago, it feels like it's been forever, but coming out of COVID, the trash, along as the rest of the economy, was, there were a lot of unknowns and supply chains and logistical problems, and the, trash and trash disposal business was certainly included in that. And some of the community, we're all coming off, all these communities, which are, none of the trash vendors will entertain these contracts, but prior to this round of contracting, pretty much every community was in a 10-year contract. So you're basically, the vendors were trying to forecast out costs 10 years in advance, and it didn't work out very well for them. And so you see a lot of communities in Massachusetts, now that they're renegotiating, and back then, we were getting told by Casella to plan for a 60 to 80% increase. And really back then, there were communities like Marblehead, for example, and while I was working there, we were in that 60 to 80% in our contract renewal. So that's kind of what we were planning for. It has come in, luckily, less than that. We're looking at probably about 20% in the first year, which is still, a lot. It's far outside our ability to, to raise given our revenue restrictions. But we have planned for it, and, we think we have a funding plan that will intentionally draw down our stabilization funds over a number of years to allow us to step in to that increase. And these are our unfunded liabilities. I always struggle with the best way to explain these, but basically, every day the town exists and continues to operate, you're effectively making a guarantee to your employees that in the future, they will have a certain retirement benefit as in a way of income, which is your pensions and retirement, and then you'll also have some sort of medical coverage, which would be the other employee benefits. So these create when looking forward, a liability on the town, because you are essentially making a promise to pay in the future today something, and that something is then quantified here, and you can see on the screen here that they are some pretty big numbers. With the pension and retirement side of things, the employees, this has gone through a number of changes over the last 40 or 50 years where, you know, the municipal worker 50 years ago had, you know, virtually no contribution to their pension, and it was totally supported by the communities. And now you have to today, and it's everything in between, but now today it's basically about 11%. Every full-time municipal worker contributes about between, it's kind of a sliding scale, but between about 10 and 12%, 10 and 11% of their every paycheck goes to the Essex County Retirement Board. So that is offsetting the liability, but there is still an existed liability based on actuarial studies. Some will argue that employees now are effectively self-funding, and you know, this liability exists because of existing promises that were made prior to the most recent round of adjustments made at Deval. Patrick made his employee pension reform, which is the most recent. I can't remember how many years ago that was, maybe 10 or 12. And so it really depends on what you look at it with that. But state law requires the liability to be fully funded by 37, Joe?
Well, it's 2035 is Essex Regional.
So 2035 is Essex Regional. So we're on basically a payment plan, kind of like a mortgage, It's just kind of amortized. Where do you got to get to by 2035? And then that's what makes up our pension assessment. So this is a pretty big spend every year, but to remember that it's only temporary in the fact that it will be fully funded in 2035. Yep.
A question on the OPEB. Can you hear me all right? Is it working? Yeah. Oh, so it says once the pension is fully funded, appropriate to the trust fund an amount equivalent to the former pension funding payment. The question is this: currently, under the pension 2035 catch-up program to fully fund, approximately 80 to 90% of the money that's paid in every year is to reduce the unfunded liability. So my question is under the draft policy, are we agreeing to the actuarial amount per employee, or are we also agreeing to some catch-up, which is, in other words, are we agreeing to 10% of, or are we agreeing to 80% on this formula? Because it's a huge difference.
So you're talking about the 20% or 80% of the total spend that we're putting into the pension right now?
Well, it says under OPEB, I guess we're drafting a policy that says we're going to once we fully fund the plan in 2035, of which currently 80% is catch-up payments. It's not actual actuarial employee payments. Are we saying we're going to do a similar annual payment, including as if we were underfunded and funding 80%, or are we funding the actuarial liability for the employees?
I think the plan is to, you know, look at that when we get there. I don't think we're actually promising an exact dollar amount, but the idea is that right now we have, you know, $1 million or $1.2 million spend that's going to the pension in retirement that in theory by 2035 will be, as you said, caught up with the liability, and then with the discount rate that will be, you know, again in theory, self-supporting, and we can then look to defer, you know, is it 100% or 10% of that to OPEB, just because we're going to be in a similar scenario. We're anticipating legislation that, just like it forced the communities to catch up with the retirement payments, they're probably going to do something. You're going to see when these funding schedules are completed, we're at 2035, but I think the law is 37 or 39, that you might see something like that for the OPEB. So we're just, you know, we're trying to be ahead of it, and we're going to know that, you know, we're basically going to be left with, you know, in the year it gets paid off. Again, you know, in theory things can change, but we had a $1.2 million spend last year, and now this year, we don't have that $1.2 million spend. So what are we going to do with that money? It's like, well, we have this other liability. So I think, you know, at least the prudent thing, what a lot of communities are looking at is, like, you know, you're going to take some or all or whatever, something in between of that money and start working towards this OPEB.
Well, I understand that, but I would ask that no draft policy be put down that could perhaps be used in subsequent collective bargaining or legislation, committing us to a catch-up fund similar to the 80% that we're legally obligated under the pension plan right now. Certainly, we should commit to whatever is actuarially required per employee, but not a similar catch-up which was mandated and is going up 10% a year. So anyway.
Jared and Gary can probably talk to this a little bit more, but I think the policy we're talking about here with OPEB was more of a general policy because maybe 6, 7, 8 years ago, there were no deposits being made to OPEB. They came up with a plan, I think the first year maybe $40,000 went into OPEB, and the OPEB plan was every year we would increase that by $10,000, and then in 2035, when we had now $1 million a year available, we would tap into that, not to any specific mechanical actuarial calculation, just saying, you know, this $1 million is coming out of the budget for the pension funding. We're going to take some amount of that to put us on a track to fund OPEB.
That's great, but that's not what that says.
Yeah,
Okay,
okay.
so I would beg you, please don't, it's the law of unintended consequences here, okay? I understand what you're trying to do, but though as worded, it's very, in my opinion, not a good idea.
We could, we'll certainly look at that.
And I'm sorry, I'll stop on that one.
No, I just, that is, I mean, what you're saying is fair and accurate, that is the draft policy that has been circulated publicly. It's come out of the select board, it's sent to the FinCom for review, so it's like anything here, it's public information and has been circulated as such. That is the draft policy, but that is exactly it. It is a draft policy, and the FinCom is reviewing, or will be reviewing over the next year, to make recommendations back to the select board on what exactly to adopt. So I think all your concerns are valid and heard.
Agenda item.
All right, so it's, basically, like I said earlier, this is, we're early stages of the budget, but I mean, this is, we're 90% there. We have some outstanding assumptions and estimates that we're kind of running on at this stage of the game. We are a bit early, given our, we're budgeting for starting on July 1, and we have, some pretty big unknowns that we're waiting to hear come in. Like one of them here we actually heard from last night, which was the pension assessment. It actually came in a little bit less than what you see budgeted for here. We're still waiting on our health insurance. The trash collection is, we're running with 20%. It could be 18, it could be 22. So that's in. So those are kind of some variables, some staffing. There's going to be some dollar amounts that are budgeted for in the presentation that you're going to see tonight, but might not live in the current budget. That like for example, building maintenance, we're looking at maybe consolidating that into one line item, so you might see some reductions in the department lines, in things of that nature. Staffing existing in certain departments that might be shifted to another department that kind of makes a little bit more sense. Again, I just think that a couple highlights as we're going through it. That this this presentation, it only covers the operating budget. Capital information will be circulated later, and like we talked about a little bit earlier, that we're being very careful not to fall into the trap of offsetting a recurring operational budget with one-time revenue sources, being free cash or stabilization. So what you're seeing here is what we're trying to budget for, pairing it to our reoccurring revenue sources, and the expectation is that, similar to the past and common in Massachusetts, that capital requests, given their one-time nature, will be and continue to be funded with our certified free cash amount. All right. So these are the key drivers. They're all going to be talked about at length as we move through, so I won't spend much time here, but I think the elephant in the room is the 11.64% operating request from the Hamilton-Wenham Regional School District. Again, this is similar to similar to ours. This is our first pass. That is their first pass. You know, like they always tell us, they're gonna, you know, really sharpen their pencils and go to work and, you know, try to get it down from there. But they usually start on the high end, but that's what we're looking at right so far. So I think, you know, really the takeaway from this slide is that we have a bunch of fixed costs that are exceeding our revenue growth or our ability to raise revenue. And, you know, I think one thing worth pointing out that, you know, although the wage increase is 3.74%, we just, last year was the first year of three of our four unions was the first year of the contract. And when looking at staffing costs as a whole, the salary adjustments we've been able to maintain at about slightly below 9% to slightly above 9% over a 3-year average. So you're looking at 3% to slightly below 3% salary and wage adjustments over a 3-year period. So, you know, some, depending on the union agreements, some are more in the first year, some are less in the out years, some are more in the middle, less. So you're gonna see that number up and flow, but, you know, we're working on the library now, but we were able to successfully settle our labor agreements in what we believe to be an achievable pace, particularly given the labor pressures that we're seeing, you know, similar like with looking at Republic and the auto unions and the teachers unions and all that. They're coming up with numbers that are much higher than 3% a year, you know, probably 2 to 3, even 4 times that. So, you know, I think we've done good this round at keeping and trying to stay within our means, but, you know, we'll see what that looks like 3 years from now. Anyways, with that, I'll jump off, and Jeff is gonna, you know, run through kind of the granularities of the budget, and, you know, we'll kind of, him and I will jump in here and there, and any questions, let us know as we go through it.
Yeah, thanks, Steve. So this page sort of brings together a lot of what Steve just talked about here. And so this is sort of a pro forma version of what we call the tax rate recap, which takes all of our expenditures, all of our revenue sources, and comes up with what we need to raise from a tax levy in order to fund the budget that's presented at this point in the year. And then that is compared to what is the tax levy limit, the Prop 2.5 levy limit that the state dictates for us each year. And so if you look to the bottom of this page, you can see that for FY26, we ended up about $216,000 under the levy limit. A big part of that is because our new growth came in ahead of expectations. Local receipts came in a little ahead of expectations. So we end up under the levy limit. When you look to FY27, you actually see a big red number there that tells you we are nearly $1.3 million over the levy limit. You know, since I've been here, that's certainly the biggest number we've had, you know, coming out of the gate. Typically, smaller communities like Wenham, getting back to what Steve said, where most of the funding of the local budget falls on the municipality. We don't have the luxury of having 40, 50, 60% of our budget covered by state aid. You know, most of us are, you know, no small community ever like does this analysis at the beginning of the year and says, wow, we have way too much money. You know, that number is almost always red when you start and you whittle it down. But what's concerning is the number is so high this year that it's, you know, when we start and that number is, say, at about 600,000, it's a little bit more manageable. We can make some cuts, the school will make some cuts, we'll make some revenue adjustments and things like that to get under the levy limit. Looking at a number of nearly, you know, a little over 1.2, it's going to be difficult to get there. We have a couple of sort of things we can do. Steve alluded to one earlier. If we look on this slide here, Public Works, you'll see, is one of the largest growth, both in percentage and dollar amounts, at $130,000, or nearly 8%, and that's the trash contract. And so one of the tools we have available to us this year, based on what the FinCom has elected to do over the last couple of years, is to overfund the stabilization account. And so we are potentially looking at using stabilization funds over, say, the next 3 years to help sort of ease in this additional cost, for the trash collection. We knew it was coming. It's going to be less than we actually thought, but that is one area where, as Steve mentioned, we don't typically like to use one-time money for the operating budget, but because this is a sort of a one-time situation where a large increase to a needed service in town, we need something to help us sort of ease this in. So that, but even if we eliminated that whole increase, that's taking, $100,000, $130,000 off the top. That doesn't even get us to $1 million over the levy limit. So it's going to take a lot of different things. As Steve mentioned, the pension and benefits there is up about $331. That dropped by approximately $70,000 yesterday when we got our assessment. We were counting on a 10% assessment increase from the Essex Regional Retirement Board. It came in at just a little bit over 4%. We'll get more into how that works later. But that's a nice outcome for us. But again, only $70,000. We're still, taking these two things into account, we're still $1 million over the levy limit. The biggest number here is obviously the Hamilton Wenham School, the operations and the debt there, going up, over $1.5 million. That's sort of the, going to be the deal breaker for us. There's nothing we can do on our side that's going to get us below $1 million without a significant change to that one number. I will say, generally speaking, I think we do a pretty good job across the departments, managing these budgets and things like that. But at the same time, I've been here a couple years, and I have observed the way I approach municipal budgeting is, and I think a lot of folks in a lot of communities do, is you look at needs and wants, and then you actually have what you'd call nice to haves. And I think in Wenham we've crept into a few too many nice to haves. Excuse me. And I don't know if that's because we've had ARPA money floating around or CPC money floating around, but I think that's one area, we're going to have to address a little bit. It's not going to completely eliminate this number, but I think it's just a mindset that I'd like to see us address. And to kind of give you a scope of that, I'll pick on Rich Souza. So a couple years ago, Rich had a truck that was coming offline. And I'm going to call it a 2-ton dump truck, but I think it's bigger. But we had 2 or 3 of these things. And they're the really, really big trucks you see out on the highway during the big snowstorms. And we had like 3 of them. And so Rich evaluated it, and a new one was going to be like $250,000. And he looked at it and he said, I just can't justify getting another one of those just because we have one of those. Because we really only use it, if it doesn't snow a whole lot, we might only use it a handful of times in a year. So instead of buying that, he bought, I think, a 1-ton, smaller vehicle that was essentially $150,000 less. And I just think, as a municipality, when you're spending tax dollars, that's kind of the mindset you have to have. You can't always be sort of like having that thing that, it's nice to have when you need it or whatever. You need to sort of take that approach to things. So that's just something I've noticed, and I'd like us to think more about. And another thing I'd sort of like us to think more about is maybe look at things a little bit more holistically. I think we tend to look at things in silos, and we don't always think about, how that impacts other departments or what other departments' needs might be. And so I'd like to see us do a better job of that, because I think what I see a lot of times is I see requests for things that I wouldn't necessarily consider a need, and I can think of a number of things that would be a need ahead of that, but another department might not put in the request. And so, I'd like us to pay a little bit more attention to each other, and how, think about other people's needs within the system, because I think we could do a better job of that. That's the end of my soapbox on that.
Question? Is the potential upside revaluation of Penguin Hall included somewhere in these numbers?
Yeah, so if you look at the estimated new growth in the first column, on the very right there towards the bottom, you'll see new growth is $276,000. Typically, we estimate $150,000 for that. That number came in at about 276, so, and Terry can correct me on this, but I would say technically new growth maybe came in a little bit shy this year of our target, because Penguin Hall added about $150,000 to that number. So technically, we were targeting $150,000 for new growth, and we probably only came in at about 125 in true new growth. And that was a point I was going to make, so I thank you for bringing it up.
I'm sorry, so it's in the 26 number?
It's in that 26 number,
Okay.
and then that 26 number, when we roll to 27, the net, if you look at the levy limit the next year, it goes from 21,332 or 21,332 to 22,148. The levy limit and the estimated new growth in column 1, those get added up together, and then you add 2.5% to get to that 22.148 million number in the next column. So it's built in now, and it's, now is just part of the base, but we got a one-time adjustment in FY26 for that coming on board. I mean, the interesting thing with Penguin Hall is that it was probably one of its largest taxpayers for many, many years, and then it went away. And now, now it's coming back as new growth. So, that's, that will be interesting to see. What's that?
Don't tell the state.
Yeah. Will that, my hope, obviously, is that continues as a taxable entity and stays on the tax rolls. I mean, in all likelihood, it will not be, the type of building it is now. It's probably going to be developed in some way, that hopefully will produce even more, more new growth for us there. But yeah, that's in there, and that's a one-time adjustment, and that's why you see, the new growth drops back down to 150 next year. And you hope we can keep pace with that 150. As we see, we probably didn't this year. We've been well over the 150 for many years, but this is part of the exercise of doing this, is that one of the reasons the numbers look bad is to start out, you're always being conservative. If I ran you a 6-year, average of estimated new growth, it's definitely over 150. But you don't want to run into a problem where the entire budget and being under the levy limit is predicated on $275,000 of new growth, because as you can see here, even with Penguin Hall being thrown in as a one-time 150, you only get to 275 this year. So, we have to take these conservative approaches, and that's why you end up with free cash, because you take the conservative approach up front. And then the real numbers, get certified, and the revenue does come in a little bit higher. Yes, Bob?
Could you comment on how the past due tax payments that were collected reflect in the budget, and the timing of when that money might be available to use for some purpose?
Sure. So what Bob's alluding to, and a lot of you in the room probably know, but we had one significant property that had back taxes on Larch Row. I think technically it was 2 properties. And then we also had another property, I think over on Maple Street, that is, I don't think it's closed yet, but the sale is going to close soon, and we will receive actually another $200,000. But the Larch Row property brought in about $700,000 of back taxes. And that our treasurer, Belinda Young, deserves a lot of credit for working hard to correct a tax lien that was done incorrectly in the past, get that tax lien reapplied, and just chasing it down over the last few years, and essentially forcing a sale of the property and getting the town paid. So we have $700,000. We're probably going to have $900,000 that will come into our cash this year. We can't use it for our budget in FY26, even though it came in. What will happen is when we close our books in June, the state will certify our operation, and they'll calculate our free cash, and that will become available for, whatever the town, deems it will appropriate it for. But that amount won't be certified until after July 1st. So it's not free cash that's available to us in our meeting coming up in April for this budget we're talking about. So it's really going to be more of something we would either have a special town meeting later in FY27 where we would appropriate some of that money, or it would be appropriated at annual town meeting in April of 2027. And that will be a one-time thing for us as well. I think we have some ideas internally on how we could utilize those funds. Getting back to Jared's point on OPEB, it might be that's a time we sock some money away into OPEB to get ahead there. I'll talk about some uses I have, planned for it when we talk about the finance budget. But yeah, those 2 points are both important parts of what's going on here.
Just two follow-up questions, Jeff. So on that point, what you're saying is that $900,000 is not going to be in the mix as a potential source for closing any part of what now is a $1.2 million gap.
Exactly.
Okay.
Unfortunately, it wouldn't be certified money by it, and this is one of the sort of nuances of municipal finance. It is absolutely, the 700 has been collected, and it's absolutely, money sitting at our bank right now, but under the Mass General Law, we're not allowed to utilize it until the state's certified.
Yeah, it's kind of crazy that we have it, and yet it can't be used potentially until the next annual town meeting.
Yeah, and that's the basis of fund accounting, is basically everything, all of your operations, your expenses and your revenues go into what are called control accounts throughout the year, and at the end of the year, you close those into undesignated fund balance.
Right.
And so until you go through that process of closing it out, putting it into undesignated fund balance, and having the state say, give it their blessing,
Right.
it's unavailable. And because of the timing, if say it wouldn't work because we have to have a meeting before June 30, but if we had a meeting in August to do this budget, we would be able to utilize it. That does raise the point of you could make the case to have a special town meeting in October, November, when free cash is certified, to adjust the budget. First, if we end up making some harsh cuts on our side to get the number down, you could sort of say to the departments, things might be tough for a little bit, but maybe we can help you out with a special town meeting in the fall.
Right. This is my second follow-up question, and this relates to the Penguin Hall point. I know we don't want to spend too much time today talking about past or looking to the future here, but explain again, if you would, whether the 276, first question, the 276,330 in estimated new growth, that's an actual number, that's what came in, or that's last year's projected number?
That's an actual number that Terry
Okay.
prepares on the assessor side of the ledger, gets submitted to the Division of Local Accounts. They certify it.
And that's okay, so that's a real amount of money that has come in. And did you say that 150 of that is relating to Penguin Hall?
Basically,
How
yeah.
is that the case?
So just to kind of put a little bit more color around what new growth is. So new growth is that you have new growth. So someone builds a new great room on their house and it's worth $100,000.
Right.
That $100,000 is new assessment. New growth is the $1,500 of tax that would be generated by that. So Penguin Hall itself is worth roughly $10 million. When you apply the tax rate, that's about $150,000
Oh, I
of
see.
tax. So new growth is an actual tax number.
I see.
Yeah.
So it's a reflection of the fact that Penguin Hall went out of business and is no longer going to be hosting, that property is no longer going to be hosting a nonprofit.
Exactly.
Okay, it has nothing to do with property tax revenue that came in from that property in FY26.
Right, well, it will actually come in. So it will become, because as of July 1, it no longer meets its charter to be a tax-exempt educational institution. Terry almost, they didn't get a tax bill for November, or for August or November, but now we do our, what are called your actual tax bills, Q3 and Q4. Those reflect, everybody gets their new assessment.
Okay.
Penguin Hall, now they say,
Yeah.
well, we didn't get you in August, but now we know we should have been taxing
I
you.
see.
So
Yeah.
it's a big hit. They
So
have to actually.
someone will be paying that, whether
At
it's...
closing,
whether
someone will
it's
pay us that.
Right, whether it's the bankruptcy trustee or the new owner or what have you.
Okay, that was
Yeah.
my question, yeah.
Just jumping quick on new growth, like a good way to look at it is, new growth is, and this is a situation of new growth, that it's, you can just basically blankly, if it didn't exist in the prior year and exists this year, all that money is considered new growth in the state's eyes. And the reason for that is because Proposition 2.5 restricts your prior year levy by 2.5%. And then you have the plus new growth, which is a mechanism in the law that allows the communities to expand their tax base beyond the 2.5% to account for perceived additional infrastructure that's going to need to be built to support those additions. So that's why it's kind of like a separate line adjustment. You have your last year levy plus 2.5%, and then you take a look at your list of everything, including new homes, additions, exempt parcels that are now non-exempt, and you build a list of, essentially like a mini tax levy for those specific items that didn't exist in the prior year, and then you add it to your last year's levy plus the 2.5%, and that's new growth. And then the year after that, that new growth is rolled into is now part of your prior year levy, and you earn, I guess depends on the way you look at it, but you get 2.5% growth by law, or any, from 0 to 2.5, or even whatever the community wants. But by law, you can grow that by 2.5%, and then you look at things that didn't exist in that year and the new year, and you kind of build that new growth list, and then the same thing happens going forward. It happens every single year. And that's that estimate, because you don't know exactly what that's going to be, and we're conservative at 150, and that kind of can be 100, it can be 300. I mean, you'll have years when a big development comes on, like we were looking at Pulte Homes, we probably would have realized $1 million a year in new growth over, I think they were 20% of our budget. So you're probably looking at like $1 million in new growth a year over for 4 years straight as that development came online. But then it goes away. It's not like you keep adding $1 million. The $1 million is rolled into your budget every year and then moving forward. If that makes sense.
Yeah, I'm actually thinking of, and I think you had a slide on this at one point, but the idea behind new growth was, so Prop 2.5 said you couldn't increase existing people's taxes more than 2.5, or not each house, but in the aggregate, you couldn't increase taxes on your assessed values more than 2.5% a year. But the concept of, if you took a simple town, right, that had 2 houses and it cost $10,000 a year to run, so let's just say it costs $5,000 a house. Well, if a third house gets built, presumably it costs more to run the town now, right? There's more kids to educate, there's more public safety coverage needed, whatever. And so that's where the concept of new growth came in. It's sort of interesting when you think of, something like building a great room or improving your kitchen, it gives rise to new growth, because it doesn't really increase the cost of running your town if someone puts in a new kitchen or something. And Penguin Hall kind of falls into that too. Just because they lost their charter on, as of July 1, it didn't make their impact really on the town of Wenham any different. It's just they switched from tax exempt to taxable status. So, it's sort of a different thing. I wouldn't think it happens all that often, and certainly not at something of that magnitude. So, all right, let's.
So Jeff, I've got one thing I just want to point out. So the folks that are here, and I see department heads and I see citizens here, and I just want to point out something. The 4 folks that you see here on the Finance Advisory Committee were primarily chartered to help shepherd the budget and be the first kind of volunteer citizens to kind of challenge things and make sure that we understand it and make a recommendation to the select board at the town meeting. So can you go back a slide, Jeff? As you heard Jeff mention before, the questions about nice to haves, need to haves, these sorts of things. This group of 4, and hopefully a 5th soon, is going to be asked to stand up at the annual town meeting and make a recommendation for this budget, right? And right now, the way it's coming in is that $1.2 million. We as a group have to decide, are we going to recommend this, right? And 1.2 million over the levy limit is like a 7% tax increase on all the citizens of the town. right? So one of the things that we're challenging the town, and the department heads are here, I appreciate that, and the citizens also paying attention. You know, what we are struggling to do, we struggle to do every year, is understand whether we're comfortable with the increases that you see on each one of these line items, right? Are they, is this a reasonable expectation with where the economy is, what the level service is, how things are going with the trash, these sorts of things. We're asking the town and the department heads to help us not just look year to year to year about the changes that are happening in the town, but also help us benchmark it against neighboring towns for each one of these line items, right? So is the cost of public works, is the cost of public safety, is the cost of education that we are funding as citizens reasonable, right? Is it on par with our neighbors? Is it significantly more? Is it significantly less? Why? Are we okay with paying significantly more than a neighboring town because we, as you know, Wenham citizens, want to have, you know, superlative service? So as you guys are looking at your budget and working with Jeff, just understand that this is something that we're pushing on Jeff to do, to help establish those benchmarks and think about it. So I know you guys are having those conversations with Jeff, but this is what the Finance Advisory Committee has asked him to do, and that's where that pressure is coming from.
Yeah, and I would add to that, it's not always just neighboring communities, but we're also evaluating, you know, what we consider reasonable, you know, comparable communities too. And that is different for, you know, it's not the same for every function in Wenham either, I think. Yeah, I think what the FinCom is trying to do is a really interesting undertaking, and I think can be really helpful. It's going to prove to be a lot of work. But at the same time, moving forward, I think it will help the budget process, because if we've done the due diligence to say we understand how we operate, we understand why it's more or less than a comparable community, it makes it easier to move that budget through and stand up at a town meeting and say, we support this wholeheartedly. And so, you know, I think there'll be things we learn to help us streamline. There'll be things we do that helps other communities streamline. I know I've had conversations with West Newbury where we've exchanged some of those ideas, and we'll do it with a few more. But yeah, thanks for making that point. This will sort of, it just takes that prior slide, and it just kind of shows you, you know, in a pie chart, you know, what the budget really looks like. And Steve sort of alluded to this earlier. So the school budget in Wenham and in almost every community is somewhere between 50 to 57% of the budget. In Wenham, it's just under 54%. And that's, you know, pretty standard across most communities that are similar to us. And then it sort of follows suit. I would say we're similar to most communities. You know, public safety is, you know, sort of your second biggest piece. Pension and benefits up more towards the top is your third, and then public works is fourth, and then general government is fifth. That's pretty standard in most communities. But if you think about that, you know, if you look at the top of public works and then go all the way around, you know, to the general government, the top of general government, you know, there's a whole lot of little slivers of the pie in that top, you know, whatever, 1/3, 1/4% of the pie up top. It's really those five things that are the, you know, the key drivers. And, you know, pension and benefits being third, you know, that's what makes, you know, managing headcount and staffing, you know, so important, you know, for a small town like Wenham, because in addition to, you know, adding staff in any of the departments on a full-time basis is not only going to increase whatever the specific budget is, whether it falls under public works or general government or whatever it is, but it's also going to add to that pension and benefits piece as well. And I think we do a pretty good job of that, where we, you know, where we make good use of part-timers where we can. And, you know, I wouldn't say we're too top heavy on full-timers, you know, as we look at it sort of generally for Wenham. But, you know, what this all represents is about $28.2 million is what needs to be raised. That's what's not covered by state aid. It's not covered by local receipts. It's not covered by any other revenue source we have. That's what we have to, you know, levy on the taxpayers. And looking at that, we really need that to drop to about 27 million to get to the levy limit. what we've done here, we've broken this presentation up into sort of functions, and this is how the DOR looks at things. General government, public safety, public works, education. And so the first slide here is general government, and this is, I sort of tell people that, this is town hall. If you want to sort of think of it, just kind of the general operation to run the town. It's not the direct services, it's not public works, it's not public safety, it's all the things that, this is sort of the engine that makes the rest of it run. If Terry doesn't do her work in the assessor's office, we don't assess the property. Once the property is assessed, then Belinda in my office, we've got to actually, issue tax bills and get the money collected. Then you move to, the select board and Steve's office, and the clerk and land use, things like that. Then we start, kind of just running the general operations of the town. And this is, if you look at us, we're going up about 3.8% in total. It's about $80,000. We go from just over 2.1 to just under 2.2 for the year. There's a couple of, it's interesting when you look on the far right side, there's some numbers that are big percentages, but maybe aren't necessarily big numbers in terms of dollars. But, one of the big ones is that if you look down at that municipal audit number, that actually covers two pieces. It covers our municipal audit, and it also covers our OPEB valuation actuary that we used to do that every 2 years. So this happens to be a year we're doing a full valuation of the OPEB. So there's a $6,000 charge in there, and that's why you see the increase in the budget for this year. It's actually a $7,000 charge, but our new auditor, we are going to be paying $1,000 less, so that the net is $6,000 there.
Jeff, when will the new OPEB report be available?
Probably sort of by the end of the fall of 2026. I would say we submit all of the the payroll and personnel data and the health insurance data to the actuary probably starting in the spring, and he amazingly turns it around pretty quickly. So I think usually we have a draft September-ish. And usually the draft is pretty good. There's not a whole lot of revision. And
the pension's on a 2-year cycle as well, right?
Yeah, the pension does. They have been in the past. They do sort of an interim one. We in Wenham for OPEB we do one every 2 years. By comparison, in Essex we did a full valuation for OPEB every year and sort of like an interim one, a smaller, cheaper one in between. And that's what the pension board's typically done, is like a mini evaluation halfway
So is
through.
this an on year or an off year for the pension? I'm just curious.
Pension should be on this year too, I believe.
It's January, isn't it?
Yeah.
Okay. Thanks.
And everything else you see here, I mean, basically most people that you see here, the town administrator line went up a little bit. That's a reflection of Steve's new contract. Most of the other things on this list are just 3% COLAs for the general government employees. This, generally speaking, this is $80,000, the 1.2 million that we're over. But generally speaking, not a whole lot of big ticket items in here. We'll kind of walk through the individual departments and give you some explanations there, but not a whole lot of room to make changes. This is one we really want to focus on. This $50 moderator budget is a real thorn in my side. I'd really like to rein him in a little bit. He actually spent 40 of it last year, which we need to talk about. The select board,
Roger's not here to defend it.
yeah. Select board, really, they have, you did add a new item last year. You added about $1,000, I think, to do sort of community outreach and things like that, which added to your general expenses. But typically speaking, it's just the stipends for the 5 select board members. So, not a lot of growth or anything too earth-shattering there. Town administrator, we've just, I didn't get into too much salary detail because there's just the one person. And then his actual expenditures on the bottom part, he's just level funding across the board there. Some of that is probably contractually obligated in terms of, having money in there for training and things like that. So that wouldn't be able to be cut. But overall, not a whole lot of wiggle room in that budget either. So let's see. Finance Committee, much like Roger, you guys out there spending $250 like it's nothing, not a problem there. Reserve Fund is always sort of a funny one to explain. So every year, historically, Wenham allocates $125,000 to the Reserve Fund. And what that is, for those of you who aren't aware of it, is the Finance Committee Reserve Fund is money set aside for what is deemed sort of unusual, unexpected, emergency type things that occur during a year that the Finance Committee is given authority to free that money up and pay for something, in another budget, or maybe something that's not even in a budget because it was so unusual and unexpected. But the reserve fund is actually not a budget that gets spent. It only gets transferred. So anytime, when someone says, oh, we need a reserve fund or an emergency fund, for this or that, the money doesn't actually get spent and charged to the reserve fund. It's actually that the budget of the reserve fund is reduced, and that budget is moved to, another department. If the police needed more staffing or something, it would be $25,000 would leave the reserve fund and it would move to the police salary budget or something. So this just sort of shows you, what I added a line here just to show you, in FY24 we allocated 125, we only spent 87. Last year was a more challenging year. We had 125, but we spent 108. And then in the current year, sort of historically, we're sort of ahead of schedule. We've already spent 47.5, and we're basically, just through November. But we've got a couple of, big ticket items in there early in the year. And one of those is the $25,000 we had set aside for the food pantry, which, at some point may be something where, we actually rescind and move back into the Finance Committee reserve, depending on, how things evolve in that situation. So we're doing 125 again for FY27 as of right now. One of the things I tend to propose in a lot of years is actually increasing this number and making changes to actual departmental budgets and sort of right-sizing those. So if we have departments, let's say, where, there's budgets that are, the budget's 10 grand, but we typically only spend, 7 or 8, maybe we reduce that budget by the $2,000 or $3,000. But to be safe, we add, maybe we add $1,500 to the reserve fund to account for reducing that other budget. So you're sort of, hedging your bets a little. But it puts the money, in a more general pool where we can use it to offset any expenditure versus if it's in Steve's training budget, it's just sort of stuck there, and we'll have to do a line item transfer at some point to move that out in May or June. So that's something we may look at, I think, this year, just because we're almost certainly going to need to make some cuts across the board to get down to a manageable number in terms of the levy limit.
Jeff?
Yep.
So how does this account work? Is it a balance forward, or does it go to free cash?
No, so every year it closes out to free cash.
Free cash,
Yeah,
okay.
so that, like last year, we produced $17,000 of free cash out of this. And, and I think in some years it's been much higher. It's been closer to even the 100 when you have a year where not a lot of unexpected stuff happens. Municipal audit, we've sort of spoken about already. Oh, another problem child. So the assessors, this is actually, getting back to my discussion earlier about, just kind of managing budgets in a different way. This is really a great example of Terry, kind of came to me and we worked through some things in her budget that were sort of out of whack. And so Terry's budget was in limbo because, as you might recall, we switched from sharing an assessor with Hamilton to moving the operation completely to Wenham, I don't know, a year or so, I think. And so last year's budget was sort of in flux because we, Terry was at a lower salary as more of an assistant, and we were paying a big chunk of money to Hamilton. That stopped halfway during the year, and so, actually, if you look at the FY25 actual column there, you can see, we only paid $18,000 for joint services, which was just a small amount compared to what it would normally be. Even though, Terry's salary increased, we still ended up spending less than we spent in FY24. But it gave us a challenge in how to budget for 26. And so what we decided to do was sort of look at it and say, well, what were we normally spending between, one position and the joint payment to Hamilton? And we sort of took that information, adjusted for COLA, and then came up with that number, and we said, well, okay, that would leave like $38,000 to use for an assistant. When we looked at the budget this year and we looked at what the actual hourly rate was and what the hours worked were going to be, we realized we were definitely overfunding the assistant line. And so, we didn't just leave that at the higher number and say, oh, well, that's a nice little pot of money for me to have. We talked it through, and we actually reduced that number quite a bit. I mean, you can see we dropped it by about $12,000, nearly 29%, I guess it looks like. So, that's a win for the town there. But at the same time, Terry said, well, there's other things I'd sort of like to do. We need to bump up some contractual services and, pay some people to do some, more inspections. And I know this is a focal point for the FinCom, sort of making sure that the assessing operation, is equitable and fair and staying on track and doing a good job of assessing properties. And so, as I talked to Terry, I said, sure, I mean, if you're saving me $12,000 on the top part here and you want to spend whatever it might be, an extra, 6 or something, on the actual expense lines, let's do that. And so the net result is, Terry's going to have a better budgeted operation that still comes in at 1% lower than last year. And, so I think that just kind of speaks to my point of, it's not always just, a continuation of the same. We need to sort of reevaluate our operations and figure out, do we just do this because we've always done it, or, is there a chance to be sort of more effective in how we manage the town resources here? And this is, I think, just as a really good success story is, the assessing department is already working really well, and this is only going to make it work better moving forward, but at, at a lower impact to the town. So hats off to Terry there for that. These are lumped together because they're both sort of legal. So tax title expense, every year we set aside $10,000 to work on essentially tax liens. And this gets back to the large sums of money we just collected. We don't always spend more than $10,000, but we have the last couple of years. And the reason for that is because there's been lots of legal work, on the Larch Row properties, on a Cherry Street property, on the Maple Street property. And so we overspent that budget, but at the same time, that spending an extra probably $5,000 there allowed us to collect, $900,000. And I would suspect that the $10,000 is now probably, that'll probably be more than we typically need moving forward, because we've, Belinda's done such a nice job of cleaning up so many old sort of problems. But, that's pretty standard. You want to have enough there that you can take care of things and get ahead of tax title instead of ending up in the situation we were in where, tax title kind of got out of hand. And we spent a lot of time and effort, trying to get it back under control. So that's the 10 that we typically do. The legal budget, we budget 100 every year, and we come pretty close to it, I would say, most years. You'll see we were under 90 in FY24. FY25, we bumped up, 10,000. We almost spent the whole thing. And, if you think about what went on in FY25, lots of activity around 3A. We had multiple town meetings. That was a sort of a high watermark year. But, you can't really predict what the legal services need will be. So I think, this is probably a pretty right-sized number. It's going to be pretty close to that, most years, and I'm sure they've gone over that at times in the past as well. All right, so finance, we've got, me, Belinda, Jen, and Janet. Our wages are going up a little bit more than the 3% COLA. The reason for that is back in, what was it, June, July? When did we have our last special town meeting? We approved stipends for the assessor, the town clerk, and the treasurer. And so you'll see that Belinda is going up more than the 3% because the $1,000 stipend was voted by the town meeting, and so that pushes her up over the 3% and pushes our average up over the 3% for our COLA. Our COLA is still the 3, but the extra 1,000 pushes us to 3.27. Our expenses are level funded. You know, they're pretty right-sized, I think, so, you know, we could probably trim a little bit here or there, but not a lot to do there. The one thing I want to point out here, and it relates back to this, you know, $700,000 or $900,000 of sort of found money. As a lot of you in the room know, we use an accounting software package called SoftWrite. It was, you know, just a whiz-bang product back in 2002 or whatever when it was developed, but it is absolutely a, you know, 20-year-old database system, and is not, it's certainly not an optimal system for us, but we continue to use it because it, you know, it handles the debits and credits correctly, and, you know, it does what we need, not all that well, but we get by with it. And it's only about $22,000 a year as part of the software budget, the IT budget. But it hasn't been improved or in probably 12 to 15 years now. And at some point they are going to stop supporting it and tell us we need to buy their new product, which we could go with that, or we may switch to another system like a Munis or something. But that is going to be a huge shift. We spend less than $25,000 now. Their other product is considerably more than that. Munis is probably $85,000 a year, so you're looking at a $60,000 increase for probably either of those software packages. And on top of that, there is probably a $200,000 conversion charge that all these people charge you to do. And that is why we've held off. You know, this is when you talk about, you know, needs and wants and nice to haves. Almost all of us would love to have something better than SoftWrite, but I don't need to have it. But at some point they're going to force our hand, and we're going to have to move, and I'm just trying to let people know the magnitude of what that change would be. But I have proposed to Steve that probably $200,000 to $250,000 of that $700,000 or $900,000 should be set aside for a future accounting software purchase, because it is coming, and we will ride it out as long as we can, but at some point we are going to need to address that. All right, so the IT budget, which, as I just mentioned, the SoftWrite package is part of this. This budget comes in at 167. This is an area where I don't think Steve or I would like to cut, but in theory, this is an area maybe we could find a little wiggle room. I mean, if you look at our actuals, the last 24 and 25, they're really more in the 115, 120 range. What I would say there is that our IT has been subsidized through ARPA for the last few years, so that 115 or 120 for those years might not really be a true representation of the actual IT needs. And we've moved to a largely cloud-based operation, and so almost everybody in the room has a Microsoft Office account to have a Wenham Town email, and we have that for all boards, all employees, all committees, in an effort to, I think, comply with open meeting law and things like that. But those Office 365 accounts are not cheap. And the amount of employees and board members and such is not insignificant, and so that's a big part of it. We've bought the ClearGov budget software. That's another 20 or so. So there, in these, I think Jim mentioned a software upgrade he might like to make at the Council on Aging. That sounds like it could be a reasonable request on his part. So this is, an area I've identified as a place we might be able to cut, but it wouldn't necessarily be the first place I looked. Okay, town hall, so basically we've got, 4 salaries here and then a whole bunch of expenses just to run the town hall operation. Pretty much everybody here just getting a 3% COLA. Maybe that recording secretary line is an area we could address. I don't know if there's some changes going on there. Yeah, it may go up, okay. Based on changes, okay. So yeah, so that, as much as we're here and we're looking at budgets and trying to focus on ways we could, reduce that $1.2 million number that we're over the levy limit, as Steve just mentioned, we've had some changes in the recording secretary line here where it might not actually be something that saves us money. It could actually be something that ends up costing us more, and we're gonna need to, that function needs to be filled in one way or another, whether it's, the person who does it now or spreading it across to other people, but, it's a function that has to continue. So it could be at the end of the day, and, this isn't gonna, drop to 20, it may actually go up to 28 or something. So these are the things that over the next 6 to 8 weeks we're, having to evaluate and build into a model that, gets us to a budget that works for everybody. This budget's increasing a lot. It looks to be increasing a lot. But one of the things that I've noticed since I've been here is that we run all the we had a postage line item here for town hall, but basically everything ends up getting charged there. And so what we're trying to do is get this budget to reflect what actually gets charged here, and then reduce other postage budgets that were sitting in other departments that weren't really being utilized, and all the postage was actually being paid through the town hall line item. So even though that 11, whatever that, it works out to be an $8,000 or $9,000 increase, it looks like it's a big increase to that budget. It's really, just reflecting what's really being spent here, but then pointing out that we have to adjust downward, other places. One area that we have struggled with over the last few years, and all of you can relate from your own home bills, but we got stuck in a cycle where our budget was trailing what we were actually spending on electricity and gas. So you can look and see, in FY26 we budgeted $7,300 for gas at town hall. Well, we spent over $8,000 2 years prior. So, you see some big increases there to get those budgets more on track. But what you will see down below is that there's a utility reserve that used to be $100,000 that's now been brought down to $20,000 for this upcoming year. So we're trying to adjust actual utility budgets and reduce the utility reserve. But it just made sense to get the actual budgets more in line with what we're really spending. Those are really the big ticket items there. Everything else, town meeting expense, we bumped up. Based on this year we just had, I don't know how you budget for town meeting expense. I mean, we spent $40,000 on town meetings this year. Hopefully it will not be a repeat performance this year, but I think we came up with $2,000 as just kind of a placeholder there to try to increase that just a little bit.
Sorry, Jeff, the major reason for the spike was, the significant number of town meetings that we had to have in the past year and the kind of controversial nature and having to
certainly the
schedule
number,
them.
and I would say probably more the complexity of the issues at hand was probably the bigger driver. Certainly, in Essex, we have 2 meetings every year, but without the complexity, and that we're not spending anywhere near $40,000. I think it was mainly the challenging nature of 3A in particular that was a big driver.
How does that break down? So none of that 40,000 is attributable to legal fees, for example, because that has its own budget line item. So how do the complexities
I think we probably
manifest?
charge some to that.
Well, you're talking legal fees at
Yeah.
town meeting, yeah, so what
The
it is.
40,000
Yeah, no,
for town meeting
40,000, none of that is town meeting, none of that is legal fees.
Okay, so what is it?
It's all audio visual,
Okay.
like the clickers.
Oh, that's true, too, yeah. I
overtime
forgot about the
for
clickers.
Public safety,
Overtime for public safety, yeah.
all that stuff.
Was the Bennett center venue cost or?
Free.
That
Well,
was-
the
Turn
center
around, speak closer to
itself
his
was-
mic, or this
There
one.
was no.
Sorry, yeah, sorry.
no rental fee.
Yeah, so there was no fee at the Bennett Center to use the venue. However, we did increase our public safety presence given the location size of the place. But so there was a slight increase. We also there was some additional cost above a traditional town meeting with audio visual, with the utilizing the different space. They had to bring some different equipment.
Okay, thanks.
Town clerk, Diane did a really nice job, well ahead of budget, even season even starting, of sending me real detailed list of what her needs were, staffing wise and expenditure wise. I don't know if everybody's aware, but the town clerk operation over probably the last, I don't know, almost since COVID, I mean, maybe the last 5 years or so, has really been much more challenging. And there's much more early voting. There's more, there's more requests for information from, third-party groups and things like that. So Diane has done a really nice job here of walking through, what goes into what she needs to run the clerk's office efficiently. And, looking at this page, we'll see, she's going up 4.5% essentially in total. But if we look at her wages, much like what I talked about with Terry earlier, she took a hard look at the salary side of things and was able to, minimize to come in under the sort of 3% COLA there on her increase on the salary side, because she knew that there was, there were some requirements on the expense side that needed to be addressed. And if you go through here, I mean, I won't walk through all of the items, but you can just see in the description side, all of the numbers that are in the FY27 proposed. She's really done a nice job of walking through and showing exactly, sort of how she got to that number. The one question I have on Diane's budget is if there's any way for us to utilize existing funds we have in like the early voting and election and things like that, the funds we've already received from the state. I don't know if we have any ability to maybe utilize some of that for your specific postage for FY27. I know the rules around that are pretty strict. But those are the types of things we'll look into. Are there other pockets of money available to us that we could use, to kind of mitigate some of these costs and cost increase for FY27? But she's done a nice job here of just really breaking down what leads to that roughly it's a less than a $2,000 or just about a $2,000 increase to her expense budget. I think, or excuse me, wrong page. No, it's about 5,000, but I think very well, organized and justified, but, still we'll sit down and the FinCom will sit down and try to work through if there's ways, to minimize, the impact of the increases here. As Steve said earlier, it's really the school side we can nickel and dime the town clerk budget, but it's not gonna go a long ways towards reducing a $1.2 million number. But every little bit helps, and if we do it across all the, the departments, we'll scrap together something.
Just one comment, postage, so not with respect to the town clerk's budget in particular, but the prior one where you said we're gonna consolidate more
Yeah.
of the postage, and that was, the reason why there's a large percentage increase on the general
Yeah.
government. I think just from a presentation point of view, when the time comes for some of these charts and tables to be shown to the public, I think we'd want to be able to indicate where some department postage line items are dropping,
Yeah.
just so people can see, like, oh, okay, it went up here, but it went down
Yeah, no,
here,
I-
here, and here.
I would agree, yeah. Yeah, and the clerk postage item is a little different than some of the other ones,
Right.
like, I was talking about like finance, police, that type of thing. But no, that point's well taken. I mean, we want to show where there'll be another thing we'll see later, but it's the same thing. We took an expense out of one and put it into something else. Land use department is, going up just under 3% in total. Expenses, down a little bit. And then wages, you know, at the 3% COLA, not a big budget overall. You know, this would be an area, you know, maybe we'd reduce that postage budget. But yeah, you know, again, a small department where, you know, you're not going to make a whole lot of headway. But you know, you still need to, we'll evaluate it and see what we can do. You know, one of the things that is coming up for this year is we use Sign Now. Most of the people in this room have probably used Sign Now to sign something at some point along the way. They've completely changed their pricing model and how it works moving forward. And so this might be an area where we can move you know, the charge that's being passed through to land use and other departments might be able to just be consolidated in finance. And it's, right now, it looks like the overall charge could be lower for the year than we currently pay. Right now, we're paying sort of like $300 per each department that's using it, which, you know, gets to about $1,000 in total, somewhere in that neighborhood. It's possible the total charge is gonna drop to like $700. So we have to sort of evaluate that. I find it hard to believe that they completely changed their pricing model to something that's gonna lower our cost. So we're sort of evaluating the billing cycles to see how that works. But, you know, if that comes to fruition and we are gonna be able to save money, that might be an area where we can, you know, eliminate that cost in probably 3 or 4 departments and just consolidate it in the finance department to a lower number.
Pardon the question, but what does the land use director do that the town planner does or does not do? I'm not quite sure I understand the job description.
I will, I think I'd let Kate kind of speak to that. She's sitting behind you there. Or, oh, no, it looks like.
Yeah, I mean, the land use director kind of oversees the land use department, which, you know, coordinates all uses of land owned, you know, by the town. So it's conservation, it's affordable housing, it's implementation of the master plan, signage. You know, when we look at the master plan for, you know, increased walkability of the community and the Complete Streets program that will help support that initiative. So those are the types of things that the land use director oversees and does. And, you know, really the town planner is a part-time role at about 19 hours a week. And she primarily staffs the planning board specifically and the Affordable Housing Trust. So from, you know, an operational standpoint and the needs of those specific boards, that's what the town planner does in a part-time capacity.
You may have said conservation. If you did, I apologize, but land use also covers all of the Conservation Commission and.
That's true, so I didn't say that.
Moving on to buildings and grounds, this is another area where we've moved in expenses out of a couple of departments into this one. So you'll see an increase here that looks a little larger at 9%, but you'll see the wage increases coming in at a little over 3%, which is the COLA plus adjusting for a longevity payment that's also due to employees in that department. And then what you'll notice in the bottom is that you'll see 2 new line items there: building expense police, building expense fire. Those have typically been under the actual, you know, police or fire departments. But one of the things that sort of cropped up last year was everything that could go wrong did go wrong last year, and I think every HVAC system in the entire town of Wenham failed, and a number of other things as well. And they happened in all the buildings, but what it kind of made us realize was that it would be best if we moved those expenses under the facilities director, under Mike Hardy, to let him oversee and spend that money. Because what can happen is if you have a year, let's just say, not, you know, if you had a $7,700 building expense line under the police, well, if something goes wrong at another property, that money is not available, you know, in the budget until May, when you can do line item transfers, to address a problem somewhere else. So it sort of made sense, since Mike Hardy and the facilities group sort of handle all of those improvements, or all those repairs and maintenance items, to put them all under that one umbrella, so that we had more flexibility, you know, to handle it in one budget, and rather than having it stuck in certain budgets that you couldn't get to if they didn't need the expenditure. It was sort of just trapped there in that department. So that's, you know, in total, we're moving, you know, about $8,600 out of those other budgets and into Mike's budget, and that's really the driver for what you see as a 14% increase to his budget. And overall, it's a, you know, it's a 14% increase to the expenses, and it's a, you know, a 9% increase to his total budget. But, you know, I've talked to the folks in the two buildings there where we've moved stuff over, and we came to an agreement that would make sense, and that, you know, Mike would just handle, you know, what comes up in their buildings, as he does already, but he would just have the funds under himself, rather than having to deal with the other departmental budgets. The last couple pieces of general government, we allot money every year to produce the town report. Typically comes in around $6,000 or so, and cost of that, like everything else, seems to be increasing. So that budget seems pretty right at about $6,500. And then Iron Rail, we've kept level funded at $48,200. You know, for those, you know, in the crowd who aren't completely familiar with it, you know, Iron Rail is a rental property that the town has over, you know, at the Iron Rail property, and these are just the expenses required to keep it running, you know, day to day. You will see a little bit of a change there. It seems like our gas and electric budgets were sort of out of whack a little bit there. So the net effect is, it's a, you know, the total budget hasn't gone up, but we've certainly shifted the gas and electric to be more reflective of the actual activity over time. All right, so public safety. There will be one change to this as we walk through, but it's a pretty small change in the grand scheme of things. As I mentioned earlier, this is the second biggest budget in the town after education. But, you know, obviously one of the more important things we do is you know, keeping the public safe, and providing, you know, emergency services and things of that nature to folks. Overall, the budget's going up a little over 5.2%, almost 5.3%. There will be a staffing request in the fire budget. The permitting budget has an increase in there, but we will be changing that and actually moving that increase to the DPW department after talking to Steve. And then permitting, which is, it's kind of funny, it comes under public safety, but I suppose it is. It's, you know, you have Rich Maloney out there ensuring that structures in town are safe and inhabitable and all that. And I'll talk a little bit more about the big increase in that budget, which isn't really reflective of Rich and how he's running the department, but more just kind of the nuances of the joint agreement we have with Hamilton to run the permitting. So,
Why is the tree warden budget going up by 15?
So there's been 15,000 added to the budget to maintain parks. And originally that request came through and we put it in through tree warden. But in talking to Steve, you know, we just decided, well, it would make more sense to, you know, have the money under the department that's actually overseeing parks in general, so that, again, it's sort of more flexibility of having the funds available to the department head that's kind of overseeing it in total.
Is the police department for pension purposes, part of the Essex County retirement, or they have their own plan?
Yeah, so any employee of the town of Wenham that's a full-timer,
Okay.
is a pension participant, is under Essex Regional Retirement. The only folks who fall under our umbrella, who are not under Essex Regional Retirement, are the teachers. The Mass Teachers is its own separate retirement system. And I don't know if a lot of people are aware, but the school does not actually pay into that system. That is a state-run system. So it's, you know, it's sort of an interesting thing when you look that the school represents about 57% of our budget. And they actually do pay into Essex Regional because the folks who aren't teachers, folks like, you know, the superintendent, they still pay into Essex Regional. But all those teachers, there's no cost on the school budget for all that pension. So imagine how high that budget would be if you had that pension carry on the school budget. So the police, you know, if we look at this here, you'll see their expenses are actually going down a little bit, and that's mainly driven by the $7,700 that you saw moving to the building and facilities earlier. And then the actual salaries and wages are going up about 1.2%. I think this number is a little, I think, confusing, and I think maybe the chief would agree. So there's a little bit of transition going on in the police department. We've got retirements, we've got some folks out on leave. You know, we have sort of multiple sergeants in the mix right now. And so the salary number is, you know, I sort of had to gross up the salary number for FY26 to account for, you know, folks who will be sergeant by the end of the year, folks who are sergeants currently. And so, you know, that number at 1.2 looks really good, but at the same time, I think it's, there's a lot of moving parts in this budget. But I think, you know, I've gone through it with the chief and his executive assistant, and I think we've captured it fairly correctly moving forward. But I think we will be evaluating this, you know, as things, you know, change, you know, over the next few months in that department.
Is the head count stable?
The head count is staying the same. You know, we have you have a situation where, you know, you have, let's just say, you know, you have sergeants retiring who have seniority, so you have a bit of a savings, but then the folks coming up behind them have more advanced degrees, so they have a higher cost because of that. And then we're also, as we hire new people to stay at the stable staffing level, I think one of the challenges the chief has noted is you know, it's getting tougher and tougher to hire officers. And what we're finding is we tend to be getting a lot more sort of senior and experienced folks that are the only folks who are sort of able to attract to the job here. And so they come in at a higher sort of step level. And if in conjunction with that they have also advanced degrees, they can be, you know, fairly expensive for, you know, at the patrolman side. But the staffing level has not increased, even if we talk about, you know, you'll see a new hire or something in the underlying detail down the road. It's a new hire because it's replacing, you know, you've got a patrol person who's moving to sergeant, and therefore you need a new patrol person because a sergeant, well, you're basically, you know, replacing a sergeant is leaving and a new patrol person is coming in, and then someone internally is moving up. But no, this budget does not increase actual staffing. We shifted this up a little bit this year. You know, typically we listed every single officer and you know, in all 10 folks or whatever. We've sort of broken it up into the chief, the deputy, the sergeants, the detective, and the patrol officers this year. And what you'll notice is sort of the big changes. You know, the sergeant level is going down, but the patrol officers is going up, and that's, I think, a function of that. You know, you're losing people with seniority at the sergeant level, so you're paying a little bit less there, but the presumption is the folks that we're bringing in at the patrol officer level are coming in with a little bit more seniority and maybe a little bit more education, which is, you know, making that increase. But overall, the net effect, when you look at the bottom, you know, we're really only going up a little over 1%. But as I said, I think it's a work in process in terms of how all the staffing is going to, you know, shuffle out over the next you know, couple of months here. One, and maybe I'm overstepping here a little bit, but one area in the budget I think we could address. You know, this bottom line here, the gatekeepers, and I mean, it's gatekeepers, but it says lifeguards, but it's not lifeguards, right? They're just gatekeepers. Mm-hmm. You know, we're paying $23,000 a year to employ, you know, essentially, I think, teenagers at Pleasant Pond. to essentially maintain parking and things like that. I know there's more history to it than that I'm not fully aware of. But you know, if you're just the black and white finance guy, you look at it and say, well, why do we spend $23,000 to have gatekeepers when we sell like $1,400 worth of Pleasant Pond parking passes? So when we get to the point, and we're going to be at that point where we are evaluating where we can save funds, you know, this could certainly be a place we could look, because, you know, when we talk about the fire department, we're going to be talking about potentially adding a new firefighter to deal with this, you know, the staffing issues and the response issues that you know are growing for our department and every, you know, certainly call department, I think. And, you know, I think we'd have to take a long, hard look at is $23,000 better spent on a new fire and ambulance person, or is it better spent on, you know, someone that's monitoring Pleasant Pond? That's certainly a decision to be made, you know, at a policy level by the select board. But certainly, as someone just looking at the numbers, it seems like a reasonable place to at least take a look. Police expenses. Not really a large part of the overall police budget when you think about it. I mean, the police budget's, you know, just over $1.9 million. You know, almost $1.8 million of that is wages. But there are a number of expenses that the department has. Obviously, you've got the basics of just, you know, running, you know, the electricity and the gas and that type of thing. But then there are all kinds of different services that they need to participate in and utilize. You know, I've been doing this for 20 years, and I still, for the life of me, couldn't tell you what Baypern is, but I know we have to pay it. But, you know, there's just different, you know, there's software we use that helps with the management of staffing. It helps with the management of, you know, data and reporting and all the things that are, you know, required of the public safety and the police in this instance. You know, and those, you know, add up to, you know, $13,000-$14,000. All kinds of, I mean, I don't know how many of you in the room are familiar with, you know, sort of post George Floyd, all of the states have adopted new, you know, standards for their police departments. In Massachusetts, it's called the Post Commission, and one of the things that's done is ramped up the amount of, you know, kind of training and ongoing field training and things like that are required by all police departments, not just ours. And those are certainly increasing, so that is, you know, another part of, you know, what they're dealing with on that side. But, you know, we're down just under 1% there. That's mainly driven by losing that $7,700. But, you know, certainly we can talk to the chief and see, you know, if there are, you know, places that we can nibble around the edges a little bit here and find some changes, you know, or whatever if needed. But generally speaking, it's a fairly level funded budget. All right, so fire, you know, you'll see here, I mean, it's, you know, total increase of, you know, just under 11%. Expenses essentially flat, and you know, it looks like the wages are, you know, going up, you know, a little over 13, almost, you know, 13.5% there. And as I mentioned, that's really driven by the desire to add a new firefighter. And, you know, if folks have questions, I'm sure the chief and the deputy can speak to it. But, you know, as someone who's been heavily involved with the call department in my town, or my former town, I know that staffing and responses to calls have become more and more challenging over the years. If you think of the evolution of call fire departments, it used to be that it was all, you know, a bunch of local guys who worked in town and were always, you know, available at the drop of a hat to get to calls and respond. And that has changed over time. I mean, now call departments, you have a lot of folks who don't even live in the town. If they live in the town, they probably work out of town, you know, Monday to Friday. And they have, you know, regular Monday to Friday jobs, so they're less and less inclined to make that 2 a.m., you know, ambulance call. And so one of the things that we did, if you look towards the bottom there's a line coverage, 11,700 last year. It's bumping up to a little over 12,000 this year. That was a new stipend that we added, excuse me, in FY26 to provide an incentive to get call firefighters, to agree to be the person on call, typically most useful over the weekend, to say, you know, for a stipend of really a fairly paltry sum, I mean, $50 or something, you know, you'll agree to be the guy who's not gonna, you know, go down and have a couple of IPAs at post. You're gonna stay home and be available to respond to a call that night. And that, I think, you know, maybe the chief could weigh in, but I think it's helped a little bit improving the you know, the responses and the staffing. But, you know, I know Essex, we put something like that in place a couple years ago. There's less and less call firefighting forces out in the state of Mass, I think, you know, generally speaking. But they're all using this kind of a tool to try to help drive that staffing and get that coverage. Because if you think about when we look at this with the new firefighter added there, that would actually move us to 5. But, you know, you've got the chief, the deputy, you've got 2 firefighters, you know, on staff now. But, you know, those 4 folks are really covering everything. You know, they're covering 7 days a week, 365 in some fashion. And then you're looking at using the call firefighters to sort of supplement that. And it's just getting more and more challenging for that, you know, to work. So the idea is that, you know, one extra person who's got another 40 hours that they can provide to be part of that you know, that 7-day-a-week coverage would go a long way towards making it so, you know, the existing guys, either your 2 exempt employees at the top are you know, if they're working, you know, much more than the 40 hours a week, you know, they're not paid because they're exempt, but it's certainly wear and tear on the chief and the deputy. And then on the firefighters, if they're working more than the 40, well, now you're paying overtime. And I know Jeff and I have talked about, you know, they run into a situation where, you know, they don't have overtime left in, you know, January. You know, which again sort of puts pressure on the chief and the deputy to, you know, be the folks who have to respond because they don't have the overtime to let the other 2 firefighters respond. So, you know, certainly, you know, we don't have the luxury of telling folks that we have available not to respond because we don't have overtime money in the budget. So, you know, maybe, you know, if for some reason the town didn't want to move forward with the new firefighter, you'd certainly want to look into the overtime wages, because if you don't have the extra body, then you're going to need to have more overtime available to have the 2 existing firefighters, you know, fill those staffing needs. You know, we did build an increase for overtime as well, just as part of that, because, you know, as I mentioned, we're dealing with that coverage issue and that, you know, running out of overtime too early in the year. You know, so this is, I'm sure, something that the Finance Committee, I think David is on this, you know, we'd have to hash out and talk through with the fire department on, you know, what's the right number for, you know, the new firefighter number is kind of set, either you do it or you don't, but the, you know, the overtime number, you know, they can hash through that. But you know, generally speaking, you know, I like to say there's sort of 3 types of fire departments at this point. There's a fully call firefighting department, which is kind of like Essex. Then there's sort of what I call the hybrid, which is more of what Wenham is, where you've got some people on staff, you've got the chief deputy and 2 firefighters, and then there's the Manchester model, which is, you know, a full firefighting force. And, you know, we're looking at, you know, a budget of, you know, we're looking at a budget of $1 million, you know, or $1.1 million here this year proposed. You know, Essex is probably at, you know, 650 or 7, you know, maybe close to 650. But then Manchester is probably at 2.3, you know, so, you know, every department, if you're Essex, you're trying to hang on as long as you can as the full call department. If you're Wenham, you're trying to hang on as long as you can as the hybrid, and not get to the Manchester, the full department level. But, you know, it is something I talked a lot about in Essex. Is, you know, folks really need to understand that the value a call fire department plays, because, you know, we always said in Essex it was saving us at least $1 million a year. You know, here it's probably saving us something similar compared to a full department. So you know, folks don't like adding headcount, don't like adding expenditures, but at the same time, you know, I think when you're dealing with the call fire department, you have to be wary of being a little penny wise, pound foolish. You know, if you suddenly make it so difficult to staff and run your call department, you're just forcing yourself that much quicker to the full-time department. And, you know, I would imagine, you know, Chief could probably weigh in, but, you know, I don't think you're just talking about staffing. I don't know that the building you have is maybe even sufficient to have a full-time force. So, you know, whatever you can do to keep at least a hybrid call department going, you do that as long as you can. You know, this is their expense side, really, you know, not going up. It's pretty much flat, all things considered. On the police side, we moved the entire building expense over to the facilities department. We actually left some of it here in the fire department, and the reason there was some of the fire guys, you know, I think they actually do a lot of the stuff. They actually run to, you know, whatever, run to Lowe's or whatever it might be and do some of the work themselves. So we left them a little bit there to continue with that type of maintenance. So certainly removing, I think we removed like $850 there. Other than that, everything is kind of flat across the board. You know, much like the police, it's really the staffing is the driver. It's not the expenses of the fire department. You know, it really comes more in the form of capital for them. You know, and that's, you know, also, you know, I like to point out when folks are doing things well, and, you know, we've got a ladder truck down in Connecticut right now, which the town was, you know, kind enough to approve a sort of a full renovation of that ladder truck, you know, which was a smart move on the town's part, because, you know, for, you know, less than a couple $100,000, you are refurbishing a truck that would cost you, you know, easily $1.5 million, you know, to replace. And so usually that's one of the hallmarks of a good sort of call fire department as well, is they're really good at maintaining their equipment and letting it last long. And for smaller departments like ours, typically the only time they get rid of stuff is when it will no longer, you know, won't fit in the building, or whatever, or they hold on to it until, because the new one won't fit in the building, excuse me.
Well, I'm also a resident. I don't want to see my taxes go up.
Oh, we'll address your assessed value. We'll take care of that, don't you worry. Permitting. So this, I was actually just talking to Steve about this the other day. So, you know, I mentioned earlier, Terry does a really nice job in the assessor's office. I know folks don't always love their assessed value and their tax bill, but the reality is, you know, the important part of the assessing office is to make sure that, you know, it's accurate and it's equitable. And I think we've, you know, there's been some growing pains over the last few years for residents as they had some sticker shock. But I think we've really done a nice job of, you know, getting things, you know, where they need to be. And we have a great plan to keep monitoring that moving forward. The other side of that equation, and part of the reason I think Terry and her group are able to do that, is because Rich and his group do their job. And, you know, referencing Essex again, a town without a really good, robust building inspection department, you know, I know firsthand how detrimental that is to just how the whole engine runs. And so, you know, this, you know, when we talk about sort of joint partnerships that really work, the library, as Bob is, you know, proving through a lot of comparative data work, you know, the library is just a really, really great joint venture. You know, we really get a great economy of scale and we get a good product out of it. But I would put the building department right up there with it, because we really have a great professional organization that's doing the work they need to do and doing it well. And that just helps everything downstream. And so, you know, I think we're really fortunate that we're able to, you know, have a department that even at, you know, $120,000, you know, Maggie does a great job with the residents. It's just really, really running well. And so, you know, Rich emailed me and said, what in the world is going on with my budget? Why is it going up so much? And what you can see is, it's, you know, as I said to him, it's nothing to do with what you're doing. You just keep doing what you're doing it well. The issue is, for the joint programs, and I know Hamilton has kind of the same issue, because I've spoken to Wendy about the other side of it, where we run the library, but, you know, we bill them. You know, when you have stuff that's not totally under your control, it's tougher to budget. And I think the building permit one is probably the hardest one, because it's not, even something like the library is just based on assessed values. the building inspector one is a little bit on assessed values, it's a little bit on the number of permits, there's a lot more variability to it, so it's tougher and tougher to predict. So, what you can see is, we just, we've been trying to catch up with it for a bit, and so we've grossed it up to try to get, sort of where we think, the budget is gonna be, moving forward. And so you see a big increase there. It may or may not be that. I'm gonna speak with Wendy and try to exchange, I'll give you the library if you give me the joint rec and the building permits, to get those a little bit more in line with where we think they're gonna be. So that number may not hold. That number is gonna need a little bit more fine tuning with Hamilton, but I just wanted to point that out and also sort of give kudos to the permitting department, because I just think they're such an essential part of what we do here. And on the bottom there, you can also see, Wenham used to absorb software charges years ago, and they shifted to a different permitting system a couple years ago now, which actually shifts the permit software cost to the person applying for the permit, which is, essentially moved that off of our expense line, and then put it onto the person applying for the permit. So that's been a savings for us as well. And I think that, as far as I can tell, financially, it's working well, and I think for the contractors and stuff, it's working as well also. All right, so this is the last part of public safety. Tree warden, we have one employee who gets a stipend, that's going up 3%. Then the expenses, you can see that looks to be going up an awful lot. But as I mentioned, it's not really going up quite that much, because we are going to move, $15,000 over to be under the highway line, where it makes a little bit more sense. So really, it will just be a flat budget. It'll be a level funded budget on that side. And, I don't know if everyone's aware, but, Wenham has a huge commitment, to trees, both maintaining and planting new, doing a lot for Arbor Day. And so this is, I think a good example of, every town has its own sort of, culture and personality. And, this is probably, compared to a lot of communities, maybe a higher number. But at the same time, it's also, I think, probably reflective of something that the community deems important. So, there's tree warden. Now to the fun part. Okay, so, here, there's two parts to our education. So Hamilton Wenham Regional School District's the one we all, sort of focus on. It's the big, elephant in the room, and it's, half the budget. But we also have the Essex Tech Vocational School, which is obviously a much smaller number, but it can be challenging, because it's this here on this one, we're assuming like the same number of students continue to go to the school, and the costs will go up about 4.3%. But we don't always know until probably in like March how many students are really in the system over there, and so we always have to look at that and think, well, I think it's going to be like 350, 360, but each student could swing that $20,000 one way or the other. And I don't know about Wenham, but I know in Essex we had a couple years where 7 additional kids went to the Essex Tech, and it was a massive spike in the cost of that program, which is a fantastic program. But the issue is there's not always a great correlation with more kids going to the Voc that increases that cost with a sort of correlated reduction in the cost at Hamilton Wenham. That's always a little tough. You always think, okay, well, yeah, that's going up 150, but at least I'll recognize some savings at Hamilton Wenham. But usually that trails like a year for that head count to kind of hit. But as we talked about earlier, this is going up 11, a little bit over 11%. It's $1.6 million, I think, in total for the two that it's going up. It's really driven on the Hamilton Wenham side. On the bottom, you can see the debt portion of the school. But that's a small piece. I mean, the debt itself is probably going up, maybe $50,000. The big piece is the actual operations of the school. And there's a couple components of that. Apportionment is a big driver. So for those of you that don't know, the school bill gets, the school comes up with what it costs to run the school, net of all revenue sources, and then they take that number and they apportion it to the two towns based on a formula. And for the last couple of years, that formula has been working against Wenham, and this year is a continuation of that. And the net effect of that is if the budget had stayed exactly the same from FY26 to FY27, there were no change, revenues and expenses were exactly the same. Our cost or our allocation would have gone up $150,000 just based on the apportionment change, no actual change to the operation itself. And so that's, that's always, we've been on the good side of that as well, and it's always nice when you're on the good side, and, for this particular year, Hamilton's on the other side of that. Their budget's going down $150,000, just because the apportionment shifted. We're just on the wrong side of it. But that's, right out of the gate, you're down $150,000, which, if you think about it, they're going up about $1.5 million. So roughly speaking, 10% of the increase is just related to a formula. Then you actually, start thinking about, what are the cost changes and the revenue changes. And so basically for us, what's happening is the operations of Hamilton Wenham Regional School District, our share of that is going up $875,000. And then, some of you may have heard this, us talk about E&D, which is essentially the school's free cash. They have used E&D to subsidize the budget for years, especially since COVID. They were down a lot of positions that weren't filled, so they were, coming in under budget, and they were just rolling that money back into the operation and reducing the net assessment to the towns. They've reached a point now where, they're saying we can't afford to put $2 million of E&D, into the system to reduce the expense. We can only put $800,000. So they're reducing $1.2 million of revenue that was helping offset the budget. So again, even if the budget expenses stayed exactly the same, the net cost was going up $1.2 million. So our share of that is another $433,000. So now you're at, about $1.2 million something. And then the final piece of the pie is that, if you think back to the Cutler project, we took a few cracks at it, it didn't pass. And so now the school is left to evaluate the buildings that they have and are going to have for the foreseeable future. And they've come up with a plan to deal with, a lot of the safety issues and deferred maintenance issues that are sort of the most immediate need in the schools. And that, they're spending, I think it's like another $800,000 or so, something like that. Maybe it's closer to 5 or 6 actually. And our share of that is $188,000. And so you add up the net operations, the E&D, and then this deferred maintenance, and that's our $1.5 million right there. And so, the hope is, we'll say to the school committee, and we sort of have in the budget meeting we had a week or two ago, this isn't going to work for Hamilton, it's not going to work for Wenham, and they'll go back and look at sort of those 3 major issues. How can we reduce net operating costs? Can we utilize any additional, E&D for this year to help offset it? And finally, can we continue to defer that deferred maintenance and safety, or can we do it on a lesser scale? Those are all decisions they'll have to make as a school committee. And I like to say all of us have different fiduciary roles in this process, and their role is to do what they think is the best for the school district and the students of Hamilton Wenham. Not necessarily to, what is the best thing to reduce the tax rate for the 2 different towns. And that's fine, because that's their role, and then it's, the FinCom's role and the Select Board's role to see, how do we meet somewhere in the middle, or how do we, if we agree that this is the only way to move forward with the school, how do we fund this at the town of Wenham level in a way that, works best for taxpayers.
And Jeff, just a quick clarification. So the 1.5 number that we're seeing right now does not include the expected override they're discussing for the roof, right? That's not included.
So yes, thanks, David. The roof, it's the high school roof. is a whole different project, which is in with the MSBA right now. For an emergency funding, they would cover, I think, like 40% of it or so. But yeah, that could be, I think the net is what, another, probably 3 to 3.5 million to the towns, which, roughly speaking, we'd take a third of that. So that's going to be an override request at town meeting if it gets through the MSBA process. And I know it's in there now, but it would have to be through and approved by MSBA, in time to get it on the warrants and get it approved. But yeah, that's another, that would be a debt item that would, on top of being $1.2 million over the levy limit, that doesn't put us over the levy limit because it would be a debt exclusion vote. We would be opting to put that over and above the levy limit, but it still rolls to your tax bill, whether it's exempt or not exempt from the levy limit. It's still a cost, and so that's a great point. Is that's another cost that's going to be potentially in the mix in April.
Yeah, just real quick, another cost that we're anticipating coming from the district is a request to fund a feasibility study for renovating all 3 schools, Bucher, Cutler, and Winthrop. So given the failure of the consolidated school, they're talking about doing basically a deep dive as to what exactly needs to be done to bring these schools up to code and in line with their ed plan. So that's going to be probably another likely debt exclusion article and probably relatively costly as well.
This just covers the Essex Tech part, which I've kind of covered already. We're just assuming the same number of students, sort of what's a historical annual increase percentage of about 4.3, and this, could probably swing, $40,000 to $60,000 either way, depending on what the actual enrollment is at Essex Tech. All right, so Public Works. If there's, 5 components here. Highway Department is always sort of a misnomer, I think, because it really covers the roads, but it also covers the parks and a lot of other different things. Snow and ice, for those folks who aren't aware, snow and ice is basically the one budget that we are allowed to overspend, and because of the uncertain nature of snow. And so what the DOR does do to us is they say, well, you can't get cute and say, okay, well then I only think we'll spend $10,000 on snow removal this year. They basically make it so you have to spend what you budgeted or spent the prior year. I think the only time they gave us any kind of leeway was back in 2015 when they said, yeah, you're not going to assume you have that much snow again. So that stays typically level funded. Or whatever, but then street lighting is one you're going to see. It's just the budget has been under. We've got a $23,600 budget. I mean, that's what we actually spent, going on 2 years ago now. So that number had to be sort of redone and moved up to a more reasonable number. Trash is the big one we've been talking about all along. And then cemetery, just a small increase for a little bit of a COLA for, one person there. So we'll move through this quickly. So one thing I'd like to point out here is, and it kind of goes back to what I said at the beginning, when we sort of like think about, all departments or other departments and not just our own. But the DPW is a department that I think since I've been here and maybe a little bit before, they've been understaffed. And so when we talk about these free cash numbers we have, the DPW has probably generated, $300,000-$400,000 or more of free cash because they've had positions that were unfilled that caused us to underspend our budget and therefore generated free cash. And last year in particular, I think of they did not have full staffing. We had a little bit of a winter last year, or at least we had a couple of weeks that were difficult. And Rich and Keith Carter and the rest of the staff over there, they were kind of under fire for the response to some of the snow events. And, I just don't think the average resident understands that there were times when I think maybe there were 2 people available to plow and clear sidewalks and things like that. And so, this is something that, Rich and his department, they've they've kind of managed to muddle through and get things done. But at the same time, they were generating free cash that, turned around and bought capital items for other departments. And this is where I feel like folks should be mindful of, I think Rich actually took some like unwarranted attacks at town meeting, that, he did that so that we could produce free cash that someone else used to buy something. So I like people to sort of think about it through that kind of prism. So I think we're moving towards having more staffing, which is good. I mean, I think, the thing about the DPW is I think you can get by and you can do, just enough, and you can get by for only so long. But over time, the little things that, you'd like to get to that you don't get to this summer, and then you don't get to them next summer, that adds up over time. And then certainly during snow season is when you feel it the most. Because if you don't have the staffing levels and you have to deal with the DOT ruling around, how much people can be in a truck and all that stuff, two guys, 3 guys is not going to be enough to take care of a town. And people should definitely be aware of that. Overall, salaries are, going up, looks like about 2.6%. This is a little less than the 3% because largely speaking, the folks that work in the DPW, whether they're actual folks out in the field or the administrative assistant, they're all in the AFSCME union. And so that contract had some different, a different approach. And so they happen to get sort of some wage increase in year one and lower COLAs throughout. So I think they're at more like a 2.5% COLA for the year. So that's why this one comes in a little bit lower than the 3%. But you're looking at, whatever, maybe a, $18,000 increase there on the staffing side. On the expense side, we're level funding here. We've not even really too many sort of changes in terms of, like we had in other departments with the electric and the gas or whatever. This is an area where, we don't have a postage anymore. We did move that out at some point in the past. MS4 permitting, that's one that, it deals with sort of the stormwater requirements that we have, which have increased, year over year for several years. And so that's an area where we don't always spend that money by the end of the year, but we always encumber it because you just honestly can't get the folks in here to actually do the work by June 30th in a lot of years. But that is a big part of the overall highway budget. And probably a big part of that job is managing, that stormwater stuff on Rich's plate. Snow and ice, as I talked about, you just kind of level fund it. You can overspend it if you have to. I think one of the things that's interesting about snow and ice is that, people think about the plowing and paying guys overtime and things like that. But really the toughest cost, I think, in snow and ice, it's the product that they spread. Because every time the road is slick or whatever, they've got to be out there spreading, well, it's not sand anymore, right? You can just do salt. So anytime there's one, the police make a call and say a certain corner is, icy, they got to roll the trucks out and they got to spread that product, and that just continues to get more and more expensive every year, and it's probably the biggest component of what we spend, which I think most people wouldn't actually think. They would think it was more the labor. And as you can see, we have some contracted plow trucks, which is very common, especially for small communities like ours, because as I mentioned, you just don't have enough, bodies to be out there plowing an entire town and cover the entire town, and especially in these continuous snowstorms. It's challenging for the smaller communities to get these folks, and harder every year, I think. But that's not all that big a part of the budget either, but it's certainly a big component of how we manage snow. Street lighting, yep, just, I talked about it a little bit earlier, but yeah, I mean, we were budgeting, what we really spent in '24. We were budgeting much less than we spent in '25. So we've just, increased that quite a bit, to get it more in line with where, frankly, that could even still be low, based on energy prices these days. But, that's an area where, we'd love to be cutting places to get under that 1.2, but I mean, you don't, the reality is what it is. You can't ignore the fact that the bill is over $30,000 and you're only budgeting 24. And this is the big one. We obviously talked about it earlier. There's a few different components to the trash. There is, the Wheelabrator trash processing, which we actually, did settle that contract for July 1 of FY26. And so there's a big increase in the budget for that. But again, we thought that could be a 70% increase or something of that magnitude, and it really only ended up being about 19 or 20. And then the Casella at the top, that, I think Steve mentioned it. I mean, that it's probably not going to be much less, but it could be a little bit more. That one is still in flux. We've had, discussions with Casella in conjunction with Hamilton to try to move forward on another joint contract. We did have discussions with other, mainly Republic, to see what someone else might charge us. And honestly, even in our preliminary discussions, they were looking to charge us probably more than Casella would to continue the contract, and they were looking for us to split the cost of a new trash truck, and potentially the cost of renting a trash truck while the one we needed was being built. So at this point, I think we're moving forward with a recommendation of just staying with Casella because they know the community. They've done a good job. We don't have the same cost of being forced to buy a new machine that we would if we went with someone like Republic. So that's sort of the course we're on right now.
Yeah, just to add, I think the FinCom and Select Board are aware, but we did form, for the folks at home, we did form a working group, and I just wanted to make the point clear that with the Wheelabrator trash processing, that we did move forward with contracting with them last year. It was not done blindly. We looked at pretty much any and all alternatives for trash disposal available in our region, and this came out by far and away the most cheapest option.
Could I just make a comment? So Finn was mentioning earlier how at the time that we present the budget to the public at town meeting and before, having some kind of regional comparisons, neighboring town comparisons on certain items would be helpful. And those of us that were on the working group that Steve just alluded to know how unexpectedly low that 19 or 20% increase is going to be, because we were worried about 30-40% potential increases based on a whole variety of factors, market conditions, and the cost of refuse collection. But I don't know whether, and Rich, you may know this, whether there's data that might be available to us where we could try to make like an apples to apples comparison with other towns who are renewing and what. Yeah.
We do have access to other towns' contracts.
Okay.
The apples to apples piece is a bit tough because town exact same size.
Right.
Is it curbside? Is it?
Right.
So we're pretty close. We have
Yep.
other towns that we can refer to.
Yeah.
At the same time.
Yeah, that'd be great. I mean, if we're able to crunch those numbers internally and look at averages or something, and presuming that the numbers come out in a way that sort of makes the point, it may soften the blow to people when they see that number and think, whoa, but then understand that it really could have been a lot worse.
Yeah. It was projected to be.
Yeah.
And I think other communities have experienced that. I know we were a couple years ahead of Wenham in Essex, and we same thing. We thought, it's going to be 80-85%, and even though we didn't have curbside, relatively speaking, we were experiencing the same thing. It was like, wow, I never thought I would be excited over a 21% increase, but this is fantastic.
Right.
And I think, because is Manchester, have they closed yet, or are they still looking?
I think they're still. I don't think everything's signed yet.
Yeah,
I'm not sure.
because I think they're on the same time frame as us.
Yeah. And the other piece is previous contracts for all towns were 10-year. Now, neither parties are really interested in doing those 10-year contracts, so the current one that we're discussing would be a 5-year.
Yeah.
But, no one, both sides of the tables don't want to sign a contract and, you know, kind of put that liability out for that amount of time.
Yeah, and I will say too, the new contracts have all kinds of different variables and escalators and, you know, fuel escalators and different things, you know, they're both Republic and Casella had all kinds of things in there to protect themselves on all kinds of, you know, downside problems, and that seems to be pretty common across the space. So, you know, if we look at this, we're, you know, in total, we're looking at probably a $95,000 increase here, which is, you know, obviously a big number. You know, that's a big component of the 1.2. But this is an area, as I said earlier, where we're looking at, we could, you know, if it was something that helps us get under the levy limit, you know, we may determine, like, let's look at using, you know, I don't know, $60,000 of stabilization this year, $40,000 the year after, and $20,000 the year after that to help sort of smooth this out and ease it in over time. You know, obviously, even if we use 60, I mean, that's not solving the whole problem by any stretch, but that was certainly the FinCom thought when we pumped all that money into stabilization. There were really two driving factors there. One was to help transition the trash cost. The other one was potentially to have almost like a bond sinking fund for Cutler to help us, you know, address that if that came to fruition. And it may still, I mean, we obviously something, if the Cutler project didn't go through, other things, something else will have to be done at the school level to address the building needs there. So yeah, so that will, you know, as we work to, you know, sort of true up these numbers, talking, you know, through the rest of the negotiations with Casella, then we'll, you know, I think with the Finance Committee and the Select Board as well, like work on strategies to utilize stabilization as a way to help make this a little bit more manageable. Because I think the key that everybody seemed to be focused on is, you know, the residents of Wenham have come to expect, you know, curbside pickup as a, you know, part of their tax bill, and we're all trying to figure out ways to make sure we can continue to provide that service, you know, without any kind of additional fee to the resident, which is certainly an option. I mean, it's under state law we're allowed to do that, but I just think, you know, everybody agreed we wanted to find a way to take this and keep it to be something that was part of, you know, your tax bill and not an additional charge for something. Cemetery, I think, you know, basically flat. We're looking at, you know, a very small increase for, you know, the burial agent is getting a 3% COLA, but, you know, we sort of left the overtime flat and left the, you know, the stipend flat as well. And that's, you know, that's one of the, you know, the boards in Wenham, I think does a really nice job. There's a bunch of folks on that board who are, you know, very invested in everything to do with the cemetery veterans, all that stuff. And so, you know, they do a nice job of, you know, understanding their budget and all the components of it and sort of keeping it on track. So yeah, level fund on the expense side, small increase on the salary. Health and Human Services. So this is an area, you know, where we probably underspend relative to a lot of maybe other communities. Our health department is largely, you know, a volunteer board, and then some part-time employees or consultants that fill in the gaps. You know, that is, you know, in some part driven by, you know, the community and the needs of the community. You know, we don't have, you know, there's not a lot of restaurants, there's not a lot of things that would, you know, maybe require you to have a full-time health agent that most communities, you know, would have. And so that allows us the flexibility to have a lower expense here where, you know, like Jared brought up, you know, he was talking about the land use department earlier. You know, our land use department is probably a little more robust than a lot of comparable communities. But we're able to do that because we sort of spend less in this area. And you know, I might have even said this to Emma at some point when she asked me a question for the news of, you know, each community is different and they allocate, we all have the same challenges. It's just that we allocate our resources in different ways. And this is one that, you know, sticks out to me because, you know, we had a full-time health agent in Essex. We don't have one here, yet we're about the same size community. But the needs of the town are very different. And so, you know, you can get by with what we have here for the health department, but the focus on conservation and trees and things like that here in Wenham make you know, the land use department more of an important function for this town. Council on Aging is really the biggest component of the budget, and then the Veteran Services, which are largely is just a pass-through from a regional Veteran Services, group, and then paying veterans. We'll look at that a bit. So, as you can see, the Board of Health, salaries are going up 3% for the COLA. We're keeping expenses basically flat from the prior year. But you can see we have an animal inspector, we have an assistant health agent, that'd be Greg, right? Frank, right, yeah. And then the nurse, which is, Mary Beth Ting, yeah.
When we say part-time, it's very part-time, like, what is it, a few hours a month?
Frank's in, once a week for a couple of few hours.
Yeah, and similarly with Mary Beth Ting is, 6 hours a month, maybe.
Yeah. Yeah, and I mean, really, the biggest line of the contract services is, that would be Greg. That would be, the septic inspections and those type of things. Little things people don't think about of just like testing the water at Pleasant Pond, that you have to do that throughout the year, and that, is whatever, $80, $90 a pop. The flu clinics and things like that. I think we do a lot of stuff at a regional level that help, can help us get by with sort of a less robust health department, because there's some regional things that help us out with things like flu clinics and things like that on a more regional nature. So that's health. Council on Aging, these folks, I think we would all agree, do a really nice job over there. It's a really great program. Jim and the staff do a great job, with the residents, make great use of the space that they have. It's certainly probably not all they would want, but it does manage to, allow them to provide a lot of both indoor and outdoor activities, and for residents, and, just very largely, well received, I think. Very similar, their wages going up about 3%. We're keeping the expenses basically level. One benefit we do have with the Council on Aging is there is a dedicated formula grant that comes from the state that does actually help supplement some of the things that they want to do over there. It's never enough, but it does help supplement the things that are, sort of outside the budget. And then, on the expense side, or salary too, I guess. But the van, Jim and I were just talking about this the other day. The van service, when they've got a shiny new van, which I think is not yet registered, but sitting over there ready to go. They really do a nice job over there of providing that service to, it's not a huge group of people, but to the folks who utilize it, it's probably a really essential service, I would say. And I know Jim's always trying to find ways to expand that service. If one of those ways was getting a grant for this new van, which will allow us to run the other one sort of secondary, and maybe provide a little bit more service. But yeah, overall, I think, having talked to Jim, over the last couple of years, this is a group that does a really nice job of providing services to residents, to a demographic of the town, which, as someone sort of alluded to earlier, probably had kids in the system at some point in time, but that was a long time ago for many of them. And where that makes, the school makes up such a large portion of their tax bill. This is always an area, just, conceptually, I always feel like it'd be great if we could do a little bit more here, because this is the one, most direct service we provide to the seniors in our community, is the Council on Aging. And, it's a little disproportionate if we're being honest. And so, I hope folks would support this, budget moving forward. Veterans, like I said, two parts of it. We get an assessment from the district to pay for the administration of veteran services, and then they just run programs, Memorial Day, Flag Day, the Wreaths Across America, all that great stuff that the Veterans Group does, and that works out to about a $26,000 budget. We're getting close here. I think we're going to come close to making that 11:30. Culture and Rec. really the big one here is the Historic Commission, but we also have a library and a joint rec. The library, as I mentioned earlier, and Bob always, points this out too, and it's something when I was thinking of coming over here, and I said, well, I'll take a look at the town budget report, and said, oh my God, Wenham spends $1 million in the library. The library runs through Wenham, and it is sort of amazing to me, and Bob and I have joked at this, that nobody ever questions that the library is, the cost of the library in our budget booklet is massive, because we're paying, even though it's only like 33% of it is ours, the entire thing is on our book. And nobody seems to question it, which Bob has always said, well, people must really like the service because, they're willing to pay 67% more for it than they actually have to. But, the library, obviously, the biggest part of this, Hamilton is paying essentially 2/3 of that, and not just 2/3 of the $1.1 million, but also 2/3 of the pension carry, the health insurance, the Medicare, and then also we allocate a certain amount of administrative expenses, so a little portion of my time, a little portion of Steve's time, that type of stuff. So, last year, for example, Hamilton paid us roughly $950,000 towards the library, which sounds great, $950 towards, $1.1 million. But really, there's a whole lot of other costs that are up on top of that you're not seeing reflected there. Joint recreation, much like permitting earlier, this is one that we're just trying to get caught up with what the budget is, and so I've tried to really build in a big cushion there. Because you can see the budget we have for FY26 is essentially the same as what we really paid in FY25, so clearly we're off pace. So, I just kind of did a compounded return of about 6.5% from FY25 to get to where we should be now. And then the Historic Commission, we, have this $200 a year budget that last year they somehow spent $7 on that. I guess that must have been like a certified mail or something. So, we'll get a little, into the detail here. Much like police or fire or much of what gets done in a municipality, most of your expenses are on the payroll side, but, the library does, they have a lot of sort of, requirements they have to meet. So they do spend a little bit more proportionally. Like if you think of, $355 on expenses is probably more than the police spend on expenses because they have these requirements to spend on books and different things to be part of, under state guidelines, and then also to be part of the Merrimack Valley Library Consortium. We have to sort of, carry our weight in terms of putting, because the system allows you to, share materials throughout the whole Merrimack Valley. It does, we have to be putting enough, materials into the system that, we're allowed to let our residents borrow as well. But we're going up, looks like a little over 4.5% or close to 4.5% there on wages. Some of that is just driven by contractual things between the director's contract, the union contract, which Steve mentioned. That union contract is coming up this year, so we'll have to at some point set aside a little bit of funding for that. But that's the only open union negotiation we have right now. So this number, could change, a little bit based on what we finally settle on a contract with that final AFSCME union there. Kim and I worked, Kim worked, I agreed it looked fine, to sort of change up how she does her expenses. And, one of the points she made, which was a good one, was that we had this this lump sum technology budget that it wasn't truly, it made it look like they were spending a ton of money on technology, when in fact, a lot of that money was like what they paid to the Merrimack Valley Library Consortium or whatever. So we can't go back, but moving forward, we will adjust that so that we can see that sort of broken out more appropriately, and you can see that, we're not spending $70,000 in technology. We're really spending $25,000 on technology, and it's the consortium fees that are really the driver there. But overall, I would say this is pretty consistent with libraries around. I mean, they all whether it's, you know, our bigger joint library or Essex's small library, you know, we all have kind of the same guidelines we have to follow in terms of funding our expenses and things like that. Joint rec, we just covered that, you know, that covers both use of the pool in Hamilton and then all the recreation services that are available to, you know, kids, seniors, you know, across the spectrum. Sean Timmons in Hamilton runs that, does a nice job with that program. And, you know, much like the library, you know, the economies of scale of having a joint program with Hamilton for recreation just allows a much more robust program than a smaller town could, you know, otherwise provide on its own. You know, I think Wenham residents should be, you know, no one likes to see a big increase, but they should be happy with the sort of the product that they're getting out of this.
So is that our 1/3 share, or is that like the library, that last number, if it's joint?
Off the top of my head, I'm trying to remember. It's mainly just assessment driven. I can't totally recall if there's any specific extra driver in there. Like, I think permitting is really the one that's the most sort of intricate in terms of how we do it.
It's just that's just our assessment.
Yeah. Yeah, I think there's a $5,000 premium on your property for the assessment, but beyond that, it's similar.
Is that why she came and visited? Yeah.
Yeah. Historic Commission, you know, I think
to be 6.
yeah, I mean, I think I mentioned to you about I mean, do they have any interest in potentially changing this budget or, you know, adding to it?
They probably want about 100K maybe.
Gotcha, okay. I mean, I guess they have the study right now, so that's probably the largest part of it.
Yeah, that's the one thing that points. They are in a study right now, which I think is much needed. I was happy to see it get funding, was to standardize, you know, the rules and
Guidelines for the
regulations,
district.
guidelines for the district.
That moves us to debt service. We're in a pretty good position here on debt service, and now there's two parts to this, right? We saw this earlier. There is, you know, about $600,000-700,000 worth of debt we pay through the school district. But on our ledger, you know, we're now down to about $183,000 of debt, and that is actually represents the last payment on the town hall project. And at that point, we will have no debt on the books in Wenham. If you recall, in town meeting in April, we utilized free cash to pay off our short-term debt as a way to reduce future expenditures and utilize free cash. So that wiped out our short-term debt back in May, and then this will be the final payment on the town hall debt, and we'll be done. And there is a corresponding debt payment out of the community preservation funds as well for the town hall debt. But yeah, as of next year, that, you know, we've got no debt on our side. You know, that's, you know, not going to hold. Obviously, at some point, we'll have to take debt for something, potentially even like a solar project at town hall, moving forward. But we're in a pretty good position there, and we're slowly, you know, reducing that down. It's all exempt debt. And actually our debt from the school district is exempt as well. For some reason, I think Hamilton has one piece of the school debt that is not exempt from the Prop 2.5 levy limit, but all of our debt is exempt, and so that means it doesn't get rolled into the budget that is subjected to the levy limit. It exists outside that levy limit, but that will be gone at the end of this year. Pension and benefits, so we talked about this a little bit earlier. So the retirement, you know, we're looking at $117,000, $118,000 there. We now know that really is going to be, you know, much closer to $45,000 or $50,000, the increase there. So that's, you know, a huge help, but again, only $70,000 change in the grand scheme of things. You know, it makes a dent, but not a huge one in that $1.2 million. The group insurance, as folks recall from the town side and also from the employee side, the increases last year from Maya were, you know, almost 20%. We're hearing initial thoughts from them that it could go up another 16 this year. So I mean, we've already talked about forming, you know, committees with other towns in the Maya world, or, you know, with an internal committee, maybe with employees and other stakeholders in the town to address with Maya how to handle this, because it's, you know, as much as from a budget standpoint, it's you know, untenable. for the employees who utilize it, it's also a huge change over the last couple of years. So, this one is sort of in limbo. We've built in the worst-case scenario to start, but I think there's going to be a lot of work to be done here because it just, this number can't hold for a second year in a row.
A question on that. Where is the retiree medical future liability accounted for within, are they part of that population as
They're part
well?
of that. So right now, what you would say is, if you think of it from like an OPEB terminology, we're
Yeah.
on a fully pay-as-you-go sort of approach to paying for medical. So that number is all active employees and all retired employees are in that
Okay.
mix.
As we move toward getting the OPEB audit this year, I'd like to get a list of assumptions that go into the audit. For example, it's not clear to me, do we require that the retirees, I know they don't kick into the Social Security system, either the teachers or the municipal employees, but what about Medicare, for example?
No, so all,
Yeah.
well, I shouldn't say all, but pretty much anybody who started at the towns or the schools after like 1968, we all contribute to Medicare. So,
Okay.
That everybody is, we don't force active employees onto
Okay.
Medicare type plans, but any retiree who is.
Okay, so that's included in the actuarial assumptions
there.
then? Okay.
Yeah, yeah. We actually had, every year I went through it with Blue Cross. We had one employee in Essex for some reason who wasn't in the Medicare system. It was like a glitch, but he wasn't eligible for a MedX plan because he was never in the MedX system. And every year they would be like, this can't be right. You must have messed it. I'm like, no, the guy is a unicorn. I don't know how he.
So whatever we're signing up to for retiree medical, it is assumed that they will obtain whatever Medicare coverage they can obtain?
Yeah.
Okay.
From an OPEB standpoint, and also
Okay.
Blue Cross comes, they send an email to the employee or retiree and the town hall, a few months ahead of time. Like Blue Cross is kicking you off too. Like they're right there telling you it's time to get off the HMO and get on the MedX plan.
And then when it comes to, I know that, indirectly, we also have a similar cost from the schools because the teachers have their own health, obviously, plans and similar negotiating dynamics. Is there any, does the town sit down with the school committee and say, who are you negotiating with and get together, or is it all done separately, or?
Yeah, I mean, we've actually talked about that, about how to consolidate that a bit more. Hamilton and Wenham are on the same system. The school is not. The school, I believe, I don't know if they're still on the GIC, they were at one point, but they're also experiencing similar increases in the GIC. They might have had some cost savings, that the plans might be a little cheaper, but the increases are similar. So, yeah, I mean, I think that's.
But they negotiate separately and kick
Yeah, they
that
use, like,
number
a
into their
third-party,
budget?
like broker.
Okay.
And negotiate that way versus like we've used Maya as our third party who negotiates directly with Blue Cross for, I don't know how many, 300 communities in the state or something. But yeah, I think all of that stuff, Jared, is on the table, for this. If we do in fact hear that, they really do come in at these higher numbers. I mean, Hamilton has heard that. We haven't heard it directly yet. So we'll see what really comes through. I mean, I know in large part the GLP drugs which was, given as really the main driver last year of the 20% increase, those are being largely, reduced as of January 1st. So I'm not sure they can use the GLP drugs as an excuse this year. So I'm not sure what the driver will be.
So last question on this, and coming full circle, I mean, where we say that, we're going to commit to the OPEB trust fund an amount equivalent to the former pension funding payment or the ADC. By the way, I don't know what ADC is, but my point is, obviously, with the current staff of both, our employees in the town and the school system, I mean, we have a current contractual obligation under collective bargaining to do what we need to do for them. With respect to the census, however, for group insurance, you've got a population that is not part of the collective bargaining agreements, that is this quote-unquote unfunded OPEB liability. And that's why I'd like to see a census breakdown as to, you know, as we go into these obligations, okay, who's part of OPEB, which is, yes, we want to do the right thing, but not a contractual obligation, you know, i.e. what's being signed up here, vis-a-vis, yes, we want to do the right thing, and we have a contractual obligation with our current employees. I think it's going to be, I think we need to see that information in some form so that as the OPEB liabilities are developed, again, to fund this supposed draft policy that we're going to sign up for, I'd like to see that information.
Yeah, I can redact our census info for you to show,
Okay.
show it to you. And, you know, what you're describing has definitely been talked about in other communities I've been involved with. You know, you always, as you say, want to do the right thing for your retirees. You know, in a large part, a lot of them worked when you didn't pay as much and whatever, so that health insurance benefit was really what they were working for, so you're very hesitant to pull the
No,
plug on that.
absolutely, which
But
is
at the
why.
same time, it is when you're looking at what am I
But we want to
contracting
go into it with a full deck of cards as to what is it, we have a draft policy, okay, but what does that actually mean in dollars and cents potentially on a go-forward basis? And I've never seen that laid out before, you know, for the town or for the schools.
I can
So-
send you the OPEB report, and the census, I just have to make, I did actually have specific people's names and things like that on it that I'd have to redact, but I can show you that. The last, you know, thing underneath group insurance, FICA, Medicare, that gets back to what Jared was just talking about. We do pay, we don't, the town does not pay Social Security. The town uses a system called OBRA. So if for those of you that, you know, are in the private world, you know, you pay a Social Security amount and your employer pays the other half of it. You know, you each pay 6.2% into the Social Security system. Municipalities, you know, in the state of Mass are allowed to take a different approach, and we use OBRA, which means we don't make a Social Security contribution. Instead, the employee makes a contribution of, I think it's 8 or 9% into an OBRA account if they're a part-time worker, which is essentially, you know, it operates like a regular retirement account or an IRA almost, and it's their funds. So part-timers, on one hand, aren't getting the benefit of accruing Social Security benefits, but at the same time, they have their own little independent account.
Well, how does that work for the full-time?
So full-timers are
Right,
who's a full-timer who's in the pension system is exempt from Social Security.
okay.
And they just pay.
Which is
So-
why it's very important to keep the pension up, because the employees didn't contribute. I think Massachusetts is one of 10 states that, for some reason, decided they weren't going to be in Social Security. You know,
Yeah, I don't know what I mean, it goes back a long, long time, but, yeah, Steve said.
1935.
We
I checked.
changed it so that we can, you know, at least the folks are putting in a much higher percentage share into the system. It's still, it's clearly not, I mean, when folks say, oh, well, now we're fully funding, you know, and that's not the case. You're not putting, you know, 11% into your pension system. If you were to put that into a 401k, it would not guarantee you potentially 80% of your final, you know, 3 years of salary or whatever. But we're doing a lot more than we were. You know, I think my stepdad worked for the state, and I think he contributed like 3% or something. So that's changed over time. But so FICA is not really a thing for us, but Medicare is, and so we're paying our half of the 1.45% of Medicare for every single person who works for the town, full-time or part-time. And that's one that, you know, we adjusted that up a little because we just, you know, you can see, again, it's another one of those where we budgeted less than FY25 actuals actually came in at. We kind of talked through this. Our general insurance fund, I reduced that a little. You know, maybe this is a place where we can find a little bit more, but, you know, as we're doing, you know, more and more things and having more park space and having more vans for the COA and whatever, the general insurance is, you know, heading up, not down, but we've definitely had a little cushion built in there, so we're trying to adjust for that. The final line on the town side is the OPEB, just going up to 10% again, and that moves us to our final piece, the water department. And, you know, this has a larger than normal increase, you know, almost entirely driven by the fact that the water commissioners have voted to increase the typical $35,000 that they put into a capital reserve account. They're now going to raise $50,000, you know, moving forward. So that's really the biggest driver here. And that's not really something that has to be, you know, raised on the tax rate, but it is raised on the water rate. And I think you folks have just adjusted water rates, right? And so, you know, this is, I think, generally speaking, the water department has done a really good job of sort of forward planning, whether it's for setting aside capital reserves, whether it's setting aside money to deal with the PFAS issue. You know, then we've received the windfall of the PFAS settlement that the water commissioners have already, you know, started to use to start planning for how we're gonna, you know, address the PFAS issues here in Wenham. But really, you know, you're looking at pretty much 3% increases for the non-union staff, 2.5% increases for the union staff. And, you know, largely the budget itself is, you know, basically flat, other than the increase I just mentioned on the capital funding. And that concludes our first look at the FY27 budget.
Jeff, sorry, you just mentioned PFAS, which was another thing that we talked about using the stabilization fund, why we established the stabilization fund. Is that an issue that we don't anticipate having to address, the, you know, capital needs or the structure of PFAS abatement in this FY27
Are you talking
budget?
specifically PFAS?
Right.
Yeah, no, nothing this year, but I mean, we're in a number of working groups with a number of communities in the state, and we're looking at, you know, basically any and every option under the sun on how we're gonna handle moving forward, whether it's tying into Beverly Salem Water Board, water supply, whether it's, you know, merging with Hamilton, whether it's building our own treatment center. It's, you know, because, but no, nothing this year. But I mean, there is likely going to be something coming down the pike, but also will likely be, correct me if I'm wrong, our majority would be funded through ratepayers. It would be presented separately from the operational budget.
Okay, thank you.
Yep.
Yeah, and that actually just does raise one interesting point. So water, while we look at it as part of the overall operating budget for the year, it is actually not part of what we call the general fund. It is a special revenue fund, and it is funded by rate paying on the water bills. And one of the things that gets a little bit, you just have to be careful with is using general fund money, which the stabilization fund is, to fund non-general fund things that are supported by, you know, sort of rate users or whatever. It's not disallowed, but it's something that folks do focus on. You know, Eric, actually, like compared to Essex, like a much larger percentage of Wenham is on Wenham Water than like Essex, right?
Yes.
Yeah, so in Essex, it's a big deal because there's hundreds of houses that don't use water, town water. And so when you talk about using stabilization funds to reduce the water rate, those people say, hey, wait a minute, like, well, I already pay high taxes and I don't use the water, and now you're taking my money and using it for water. I don't know how I feel about that. And, you know, one of the things you usually say is, well, you might not use it, but the school uses it, the town hall uses it. There's lots of government functions that use the water, so it is appropriate to use some amount of stabilization, you know, to help mitigate those costs. You know, and then, you know, obviously, water is a key component of the community. I'm certain, you know, I'm sure the people in Flint, Michigan would argue it. You know, it's incredibly important. So using general fund dollars is certainly a viable alternative, but it is something that can be up for debate. I think that's all I got.
Great job, Jeff.
Thank you.
Yeah, so just to wrap it up, great job, Jeff. But you know, I just want to, you know, thank you guys with the boards and staff for coming out on a Saturday morning. It's, you know, it's really important that we get this information out there. And you know, really, it's, you know, it's your community, and I think, you know, the staff showing up here today. Like, our goal is really to try our best to deliver the community you want. So your feedback and, you know, your willingness to spend 3 hours with us on a Saturday morning, you know, says a lot. So thank you for that. And also thank you, Jeff, for, you know, he worked hard with the department heads and clearly put a lot of work into putting this PowerPoint presentation together today. And, you know, he's been a huge asset here at the town, particularly, you know, the ability to go through the budget on such a granular level. and also just his, his experience and background, the ability to editorialize and kind of speak from the FinCom side of the table with his experience there. So it's always helpful for me too, internally, to kind of, sometimes get, reality check, if you want to call it that, the way folks are looking at the budget, and, it's helpful to me and everybody really when we're making decisions and trying to move forward. So thank you, Jeff.
Thank you.
All right, thank you very much, and thank you to all the department heads and the staff and all the hard work that went into this, many, many hours and a lot of attention to detail. Thank you, and I would entertain a motion to adjourn the select board meeting.
What time is it?
11:36.
At 11:36. So moved.
Second?
Gary?
Yes.
Peter?
Yes.
Deirdre?
Yes.
And Ben is yes. We're adjourned, thank you.
Cheers.
So,
Same thing on the Wenham Finance Advisory, I'm looking for a motion to adjourn. We got a motion, need a second?
Should we?
All right, and any discussion? Not hearing any discussion, we'll move to a vote. Finn votes aye.
Jared, aye.
4 votes for, so we are adjourned as well. Thank you very much.